The first meeting of a commission appointed by Congress to examine the events of last year's near collapse of the financial services industry. Witnesses today include top executives from Goldman Sachs, J.P. Morgan Chase, Morgan Stanley, and Bank of America. The commission, made up of 6 Democrats and 4 Republicans, is required to deliver a report to Congress by December 15th of this year. Former California Treasurer Phil Angelides chairs the commission, and former House Ways and Means Committee Chairman Bill Thomas is co-chairman. This first panel is 3 hours 20 minutes.
The meeting of the, oh good, the mics work. The meeting of the Financial Crisis Inquiry Commission will come to order. There is a quorum present, and so we will now proceed with this first of our public hearings. Good morning to everyone, and thank you for being here. I'm honored to welcome you as we start this series of public hearings into the causes of the financial and economic crisis that's gripped this entire country. I thank Vice Chairman Thomas for his extraordinary cooperation and partnership. I applaud the dedication of my fellow commissioners, and I'm grateful to all of our witnesses for giving us their testimony and sharing their wisdom. We've been given a critical mission, one that goes far beyond any party or even policy agenda, to conduct a full and fair inquiry into what brought America's financial system to its knees. We're after the truth, the hard facts, because it's our job to provide an unbiased accounting of the actions that led to devastating economic consequences for so many American families. We'll follow the evidence wherever it leads. We'll use our subpoena power as needed. And if we find wrongdoing, we will refer it to the proper authorities. That's what the American people want. That's what they deserve. And that's what this commission is going to give them. Some already speak of the financial crisis in the past tense as some kind of historical event. The truth is, it is still here and still very real. 26 million Americans are unemployed or can't find full-time work or have given up even looking for jobs. Over 2 million families have lost their homes to foreclosure in the last 3 years. Millions more have a very legitimate fear that they will. Retirement accounts and life savings have been swept away, vanished, like some day trade gone bad. People are angry. They have a right to be. The fact is that Wall Street is enjoying record profits and bonuses in the wake of receiving trillions of dollars in government assistance, while so many families are struggling to stay afloat, has only heightened the sense of confusion. I see this commission as a proxy for the American people, their eyes, their ears, and possibly also their voice. This forum may be the only opportunity to have their questions asked and answered. This forum may be our last best chance to take stock of what really happened so that we can learn from it and restore faith in our economic system. If we ignore history, we're doomed to bail it out again. And so we expect our witnesses before us to be forthright. We need candor about the past so we can face the future. Today's hearing is the beginning, not the end of our questioning. We'll hold hearings throughout the year and take testimony from hundreds of individuals. Witnesses called to testify today are likely to come before us again as this investigation and inquiry unfolds. Those who haven't yet been asked to appear should be confident of this. We intend to thoroughly question individuals and institutions relevant to our inquiry. Let me close with this thought. My father grew up in the Great Depression. Like so many of his generation, he was shaped by sacrifice, hardened by economic hardship and war, keenly aware of the financial recklessness that made his life and the life of so many others so much harder than it needed to be. His generation learned the lessons of financial disaster so that the country could avoid it for decades. Let us learn the lessons of our time. Let us be diligent and thoughtful today so that our financial and economic system can fully rebound and enrich and sustain Americans for the years to come. Mr. Thomas?
Thank you very much, Mr. Chairman. I'd ask unanimous consent that my written statement be made a part of the record. And I just want to thank all of the commissioners. We've been doing a lot of that 7/8 of the iceberg underwater, and people are now going to see the 1/8 that you usually see above water. I think all of us are conscious of the fact that these hearings, notwithstanding the drama of the hearings, is not the fundamental work that is before us. It is, as you indicated, asking the questions the American people would like answered, and doing it in a way in which we increase the understanding, the comprehension of what happened, obviously for the purpose of not having it happen again. Thank you, Chairman.
Thank you, Mr. Vice Chairman. And now we will go to the witnesses on our first panel. Let me say that it will be the common and customary practice of this commission in public hearing to swear witnesses in terms of their testimony. So this is not unusual. And with that, though, I would like to ask each of the witnesses to be sworn. And I'd like to ask that you stand so that we may swear you in, as is, I said, the common practice. I should stand. Do you solemnly swear or affirm, under the penalty of perjury, that the testimony you are about to provide the Commission will be the truth, the whole truth, and nothing but the truth, to the best of your knowledge? Thank you so very much. Now, gentlemen, thank you very much for being here today. We appreciate you coming here. We appreciate you sharing your views with us. I should tell everyone here that each of the witnesses today has submitted written testimony, which will be available on our website, which is fcic.gov. It is also, I believe, available in the room today. We have asked each of the panelists to make opening statements of no more than 10 minutes. And so I think we'd like to proceed with that. I will signal you when there is 1 minute to go so that you can wrap up. And so let's do this then. I think with that, I'd like to start with Mr. Blankfein. We're going to go in alphabetical order. Mr. Blankfein, please proceed.
Thank you, Chairman Angelides, Vice Chairman Thomas, and members of the Commission. Thank you for the opportunity to contribute to the Commission's work to understand the causes of the financial crisis. Goldman Sachs was established 141 years ago. We are an institutional-focused firm providing investment banking, market making, and investment management services to corporations, institutions, governments, and high-net-worth individuals. As an underwriter, we help our clients access equity and debt capital markets in order to grow their businesses. As an advisor, we assess and facilitate strategic options for mergers and acquisitions. We provide the necessary liquidity as market makers to help ensure that buyers and sellers can complete their transactions and securities markets can function efficiently. And as an asset manager, we help public and private pension funds, corporations, not-for-profit organizations, and high-net-worth individuals plan, manage, and invest their financial assets for the long term. To begin on a more general point, any examination of the financial crisis should set out with an understanding of some of the global economic and financial dynamics of the last 2 decades. The growth in the amount of foreign capital, 10 years of low long-term interest rates, and other factors coalesced over many years to create a sustained period of cheap credit and excess liquidity. This, in turn, generated a desire to find new investment opportunities with higher returns. Many of the best were thought to be in residential housing. One contributing factor to the attractiveness of the housing market was public policy's active support of the expansion of home ownership, recognizing the societal benefits. For our industry, it is important to reflect on some of the lessons learned and mistakes made over the course of the crisis. At the top of my list are the rationalizations that we made to justify that the downward pricing of risk was different. While we recognized that credit standards were loosening, we rationalized the reasons with arguments such as the emerging markets were growing more rapidly, the risk mitigants were better, there was more than enough liquidity in the system. A systemic lack of skepticism was equally true with respect to credit ratings. Rather than undertake their own analysis, too many financial institutions relied on the rating agencies to do the central work of risk analysis. Another failure of risk management concerned the fact that risk models, particularly those predicated on historical data, were too often allowed to substitute for judgment. Next, size mattered. Whether you owned $5 billion or $50 billion of supposedly no-risk super senior debt in a CDO, the likelihood of loss rate would appear to be the same. But the consequences of a miscalculation were obviously much bigger if you had a $50 billion exposure. Third, risk monitoring failed to capture the risk inherent in off-balance sheet activities, such as structured investment vehicles or SIVs. It seems clear now that financial institutions with large off-balance sheet exposure didn't appreciate the full magnitude of the economic risks they were exposed to. Equally worrying, their counterparties were unaware of the full extent of those vehicles and therefore could not accurately assess the risk of doing business. Fourth, assets at certain institutions weren't valued at their fair market value, the price at which willing buyers and sellers transact. One consequence was that losses weren't seen early enough, so risks weren't curtailed. A second consequence was that bank balance sheets became suspect. As a result, lending between counterparties froze. Fifth, financial institutions simply didn't have enough capital to meet the extraordinary market environment that arose after a long period of benign conditions. Lastly, the role we play in the capital markets is to support economic growth. Some of the activities we undertook contributed to the prevailing mood of the time. We didn't know it then or even today when it actually crossed over into bubble territory. But we lent money out too cheaply and in certain loans without the traditional safeguards. We didn't recognize early enough that risk was being mispriced. We made too many liquid investments, particularly in real estate, and we were too concentrated in certain areas, namely leveraged loans. Given the competitive focus on maintaining market share, we didn't see as clearly as I would have hoped the excesses, so we didn't raise a hand and ask whether some of those trends and practices that became commonplace really serve the financial system's interests. Going forward, I hope that one of the improvements made will be the creation of a mechanism by which the industry and regulators can step back, try to assess if markets have gone too far, and consider what needs to be done. In light of these lessons, it is important to consider principles for our industry and for policymakers as we move towards reform. Risk and control functions need to be completely independent from the business units, and clarity as to whom risk and control managers report is crucial to maintaining that independence. To increase overall transparency and help ensure that book value really means book value, regulators should require that all assets across a large financial institution with a capital markets business be accounted for on a fair value basis. Also, all of the exposures of a financial institution should be reflected through its P&L. In this vein, valuation and capital standards across risky assets, regardless of the form or legal entity in which they are held, must be consistent. One of the larger stresses placed on Goldman Sachs and other firms during the height of the crisis was the possibility that we were managing risk in the same way other institutions, which were severely hampered or later failed, had managed their risks. Getting the market to recognize that our balance sheet was well marked and that our reported capital levels were accurate was one of our most significant challenges. Without question, direct government support was critical in stabilizing the financial system, and we benefited from it. The system clearly needs to be structured so that, in the future, private capital, rather than government capital, is used to stabilize troubled firms promptly before a crisis takes hold. The two mechanisms that seem to hold the most promise for addressing this goal and addressing too big to fail are ongoing stress tests, which are made public, and contingent capital, possibly triggered by failing a stress test. These two elements could also be the core of a strong but flexible resolution authority. Certainly, enhanced capital requirements in general will reduce systemic risk, but we should not overlook liquidity. If a significant portion of an institution's assets are impaired and illiquid, and its funding is reliant on short-term borrowing, low leverage will not be much comfort. Regulators should lay out standards that emphasize prudence and the need for longer-term maturities depending on the assets being funded. Institutions should also be required to carry a significant amount of cash at all times, ensuring against extreme events. Lastly, I want to briefly discuss our firm's experience during 2008 and 2009. While we certainly had to deal with our share of challenges during the financial crisis, Goldman Sachs was profitable in 2008. As I look back to the beginning and throughout the course of the crisis, we couldn't anticipate its extent. We didn't know at any moment if asset prices would deteriorate further or had declined too much and would snap back. Having to fair value our assets on a daily basis and see the results of that marking in our P&L forced us to cut risk regardless of market or individual views, estimates, or expectations. Throughout 2007, we were committed to reducing certain of our risk exposures, even though we sold at prices many in the market, including at times ourselves, thought were irrational or temporary. After the fact, it is easy to be convinced that the signs were visible and compelling. In hindsight, events not only look predictable, but sometimes look like they were obvious or known. The truth is that no one knows what is going to happen, and that recognition defined our approach to risk management. We believe key attributes of our strategy, culture, and processes were validated during the extraordinary events and macroeconomic uncertainty of the past year, but they have also prompted change within our firm. Over the last 18 months, our balance sheet has been reduced by a quarter, while our capital has increased by over a half. Our Basel I Tier 1 capital ratio has increased to 14.5% through earnings generation and a number of capital offerings. Our pool of liquidity was relatively high at the onset of the crisis, but we carry a great deal more cash on our balance sheet than ever before to deal with contingencies. While we believe our firm has produced a strong relationship between compensation and performance, we have announced additional reforms in this area. At our shareholders' meeting last year, we outlined specific compensation principles. Consistent with those principles, in December, we announced that the firm's entire management committee will receive 100% of their discretionary compensation in the form of shares at risk, which cannot be sold for 5 years. In addition, we announced that the 5-year holding period on shares at risk includes an enhanced recapture provision that will permit the firm to recapture the shares in cases where the employee engaged in materially improper risk analysis or failed sufficiently to raise concerns about risk. Finally, our shareholders will have an advisory vote on the firm's compensation principles and the compensations of its named executive officers at the firm's annual meeting of shareholders in 2010. Once again, we appreciate the opportunity to assist the Commission in your critical role, and I look forward to your questions. Thank you.
Thank you very much. Thank you so much. Mr. Diamond.
Chairman Angelides, Vice Chairman Thomas.
If you touch the button on your mic, and if you move the mic fairly close to you, because they're very distance sensitive.
Sir.
Thank you.
Chairman Angelides, Vice Chairman Thomas, and members of the Commission, my name is Jamie Dimon, and I'm Chairman and Chief Executive Officer of J.P. Morgan Chase & Company. I appreciate the invitation to appear before you today. If we are to learn from this crisis moving forward, we must be brutally honest about the causes and develop a realistic understanding of them that is not overly simplistic. The FCIC's contribution to this debate is critical, and I hope my participation will further the Commission's goals. I would like to start by touching on some of the factors I believe led to the financial crisis. Of course, much has been said and much more will be written on the topic, so my comments are summary in nature. As we know all too well, new and poorly underwritten mortgage products help fuel housing price appreciation, excessive speculation, and far higher credit losses. When the housing bubble burst, it exposed serious flaws in mortgage underwriting, and losses flowed from the chain from mortgages to securitizations to derivatives based on these products. Excessive leverage by many U.S. investment banks, foreign banks, commercial banks, and even consumers pervaded the system. This included hedge funds, private equity firms, banks, and non-banks using off-balance sheet vehicles. There were also several structural risks and imbalances that grew in the lead-up to the crisis. There was an over-reliance on short-term financing to support liquid long-term assets, and over time, certain financing terms became too lax. Another factor in the crisis was clearly our regulatory system. I want to be clear, I do not blame the regulators. While they obviously have a critical role to play, the responsibility for a company's actions rests solely on the company's management. But we should also look to see what could have been done better in the regulatory system. We have known that our system is poorly organized with overlapping responsibilities. Statutory authority they needed to address the failure of large global financial companies. Much of the mortgage business was not regulated or lacked uniform treatment. Basel II capital standards allowed too much leverage at investment banks and other firms and did not incorporate liquidity at all. The extraordinary growth and high leverage of the GSEs also added to the risk. We also learned that our system has many embedded pro-cyclical biases, a number of which proved harmful in times of economic stress. Loan loss reserving methodologies cause reserves to be at their lowest levels at a time when high provisioning might be needed the most. Certain regulatory capital standards are also pro-cyclical, and continuous downgrades by credit agencies also required many financial institutions to raise more capital. When all is said and done, I believe it will be found that macroeconomic factors will have been some of the fundamental underlying cause of the crisis. Huge trade and financing imbalances caused large distortions in interest rates and consumption. As for J.P. Morgan Chase, the last year and a half was one of the most challenging periods in our company's history. I'm immensely proud of the way our employees continue to serve our customers through this difficult time. Throughout the financial crisis, we never posted a quarterly loss. We served as a safe haven for depositors. We worked closely with the federal government, and we remained an active lender. I would like to describe some of the regular business practices that we believe protected us leading up to and during the crisis. If we weren't doing these things right going into the crisis, it would have been too late to start once the crisis began. J.P. Morgan Chase did not unduly leverage our capital or rely on low-quality capital. We've always used conservative accounting and vigilant risk management, built up strong loan loss reserves, and maintained a high level of liquidity. We always believed in maintaining a fortress balance sheet. We continually stress test our capital and liquidity to ensure that we can withstand a wide range of highly unlikely but still possible negative scenarios. We did not build up our structured finance business. While we were large participants in the asset-backed securities market, we deliberately avoided large risky positions on structured CDOs. We avoided short-term funding of liquid assets and did not rely heavily on wholesale funding. In addition, we essentially stayed away from sponsoring SIVs and minimized our financing of them. Even before 2005, we recognized that credit losses were extremely low, and we decided not to offer higher-risk, less-tested loan products. In particular, we did not write payment option ARMs. As I've said before, we did make mistakes, and there are a number of things we could have done better. First, we should have been more diligent when negotiating and structuring commitment letters for leveraged syndicated loan transactions. In response, we have tightened our lending standards as well as our oversight of loan commitments we make. Second, the underwriting standards in our mortgage business should have been higher. We have substantially enhanced our mortgage underwriting standards, essentially returning to traditional 80% loan-to-value ratios and requiring borrowers to document their income. We've also closed down almost all of the business originated by mortgage brokers, where credit losses have generally been over 2 times worse than the business we originate ourselves. Even so, we remained relatively strong throughout the crisis, so much so that when called upon to take action to help stabilize, we were called upon to take action to help stabilize the system. Over the weekend of March 15, 2008, the federal government asked us to assist in preventing Bear Stearns from going bankrupt before the opening of the Asian markets on Monday morning. And on September 25th, we acquired the deposits, assets, and certain liabilities of Washington Mutual from the FDIC. Later, we learned we were the only bank that was prepared to act immediately following the largest bank failure in U.S. history. In addition, we continue to lend and support our clients' financing and liquidity needs throughout the crisis. Over the course of the last year, we provided more than $800 billion in direct lending and capital raising for our investor and corporate clients. For example, we helped provide state and local government financing to cover cash flow shortfalls. We are the only institution that agreed to lend California $1.5 billion in its time of need. And even though small business loan demand has been down, we have maintained our lending levels to small business. In November of last year, we announced plans to increase lending to small businesses by $4 billion to a total of $10 billion this year. For the millions of Americans feeling the effects of this crisis, we are doing everything we can to meet them help their mortgage obligations. In 2009, we offered approximately 600,000 new trial loan modifications to struggling homeowners through our own program, as well as through participation in government programs like the U.S. Making Home Affordable initiative. Our capabilities, size, and diversity of business have been essential to our withstanding the crisis and emerging as a stronger firm, It is these strengths that put us in a position to acquire Bear Stearns and Washington Mutual. Some have suggested that size alone or the combination of investment banking and commercial banking caused the crisis. We disagree. If you consider the institutions that failed during the crisis, some of the largest and most consequential failures were standalone investment banks, mortgage companies, thrifts, and insurance companies. Our economy needs financial institutions of all sizes, business models, and areas of expertise to promote economic stability, job creation, and customer service. America's largest companies operate around the world and employ millions of people. These firms need banking partners that operate globally, offer a full range of products and services, and provide financing in billions of dollars. But let me be clear, as I've said before, no institution, including our own, should be too big to fail. We need a regulatory system that provides for even the largest financial firms to be allowed to fail in a way that does not put taxpayers or the broader economy at risk. Shareholders, management, and unsecured creditors should bear the full cost of failure. The great strength of any organization, indeed our country, lies in our ability to face problems, to learn from our experiences, and to make necessary changes. I would like to thank the Commission for their contribution to this process and commitment to identifying the causes of the crisis. We stand ready to assist the Commission in any way we can. Thank you for the opportunity to testify before you today.
Thank you very much, Mr. Diamond. Mr. Mack.
I'm ready to go. Chairman Angelides, Vice Chairman Thomas, distinguished commissioners. My name is John Mack. I'm the chairman of Morgan Stanley. Also served as Morgan Stanley's CEO from June of 2005 to 2009, and I'm pleased to have the opportunity to address you today. The past 2 years have been unlike anything I've seen in my 40 years in financial service. Unprecedented illiquidity and turmoil. Wall Street saw the fall of 2 leading franchises and the consolidation of others. We saw credit markets seize, the competitive landscape remade, and vast governmental intervention in the financial sector. And the consequences has obviously spread far beyond Wall Street. Millions of America today are struggling to find work. They've lost homes, they've watched their retirements evaporate, their savings. I believe the financial crisis exposed fundamental flaws in our financial system. There's no doubt that we, as an industry, made mistakes. In retrospect, it's clear that many firms were too highly leveraged. They took on too much risk, and they didn't have sufficient resources to manage those risks effectively in a rapidly changing environment. The financial crisis also made clear that regulators simply didn't have the visibility, tools, or authority to protect the stability of the financial system as a whole. Let me briefly walk you through what happened from Morgan Stanley's viewpoint and our response to the crisis. As the Commission knows, the entire financial service industry was hit by a series of macro shocks that began with a steep decline in U.S. real estate prices in 2007. Morgan Stanley, like many of its peers, experienced significant losses related to the decline in the value of securities and collateralized debt obligations backed by residential mortgage loans. And this was a powerful wake-up call for this firm, and we moved quickly and aggressively to adapt our business to the rapidly changing environment. We cut leverage, we strengthened risk management, we raised private capital, and dramatically reduced our balance sheet. We increased total average liquidity by 46%, and we entered the fall of 2008 with $170 billion in cash on our balance sheet. Thanks to these prudent steps, we're in a better position than some of our peers to weather the worst financial storm. But we did not do everything right. When Lehman Brothers collapsed in early September of 2008, it sparked a severe crisis of confidence across global financial markets. Like many of our peers, we experienced a classic run on the bank as the entire investment banking business model came under siege. Morgan Stanley and other financial institutions experienced huge swings in spreads on the credit default swaps tied to our debt and sharp drops in our share price. This led clearing banks to request that firms post additional collateral, causing further depletion of cash resources. In an effort to stem the panic, Morgan Stanley moved up its announcement of its strong third-quarter earnings to September the 16th. But our stock remained under heavy pressure. It lost nearly a quarter of its value the following day, falling from 28.7 to 21.75. Despite these strong results, it continued to trade low and finally traded as low as $6.71. This crisis of confidence in the market fed a chain reaction to the broader economy as lower prices for financial assets undermined confidence and led to lower prices throughout the rest of the economy. This period was marked by rampant rumors and speculation. My management team, like those of my peers here, worked around the clock to address these rumors and provide investors, clients, and employees accurate information. We also worked closely with our regulators to keep them informed and achieve the right result for the markets and the economy. Our position began to stabilize after Mitsubishi agreed to invest $9 billion in our firm as part of a broader strategic alliance. Morgan Stanley also converted to a bank holding company, providing direct oversight and access to the Federal Reserve. The U.S. government announced its TARP investment a short while later, which also helped stabilize the broader market. And the SEC instituted a temporary ban on shorting financial stocks. Morgan Stanley appreciates the many steps the government took to prevent the collapse of the financial system and the support provided by American taxpayers. I believe every firm in the industry and the broader financial markets as a whole benefited from this support. As you know, Morgan Stanley has since repaid our TARP funds, providing taxpayers a 20% annualized return on that investment. We learned an important lesson from the 2008 crisis and have adapted our business to help prevent something like this from happening again. One of the clearest lessons was that many firms simply carried too much leverage. As I mentioned, Morgan Stanley moved aggressively beginning in 2007 to reduce leverage, cutting it in half from 33 times at the end of 2007 to 16 times by the third quarter of 2009. We raised a total of $14 billion in capital from private sources, maintaining one of the highest Tier 1 capital ratios. We've also taken a number of steps to diversify our revenue and funding sources, including through an expansion of our wealth management business and extending maturities on our debt. We have made important changes, systemic changes to our business practices, including scaling back proprietary trading. Morgan Stanley also devoted significant resources over the last 2 years to further strengthen our risk management policies and procedures. This including naming a new risk officer early in 2008 and adding about 100 more people to the risk management process. We have enacted changes to how we pay our employees and ensure that compensation is linked even more closely to performance and does not encourage excessive risk-taking. We were the first major U.S. bank to enact a clawback for a portion of year-end compensation in 2008, one that exceeded TARP requirements. We have since strengthened this provision further so we can claw back compensation for up to 3 years if investments or trading positions produce subsequent losses. We've also enacted a new multi-year performance plan that makes a portion of senior executives' year-end compensation contingent on reaching certain 3-year performance goals. And we're increasing a portion of year-end compensation that's deferred to all employees. Finally, as CEO, I recommended to the Board that I receive no bonus in 2009 because of the unprecedented environment in which we're operating and the government's extraordinary financial support to our industry. This was the 3rd year in a row that I recommended no bonus to my Board. Morgan Stanley is also doing its part to get our economy moving again. We are working with businesses to raise capital to invest in job growth. We are working with families to modify mortgages we service so families can stay in their homes. By the end of November 2009, Morgan Stanley's loan servicing subsidiary had active trial modifications in place for 44% of borrowers who are over 60 days delinquent and eligible for the administration's Home Affordable Modification Program. This was the highest percentage of any servicer participating in the HAMP program. We believe this is both business imperative and public important. The financial crisis laid bare failures of risk management individual firms across the industry and around the world, but also made clear that regulators simply don't have the tools or the authority to protect the stability of the financial system as a whole. That's why I believe we need a systemic risk regulator with the ability to ensure that excessive risk-taking never again jeopardizes the entire financial system. We cannot and should not take risk out of the system. That's what drives the engine of our capitalist economy. But no firm should be considered too big to fail. The complexity of the financial markets, financial products, and exploded in recent years, but it's clear that regulation and oversight have not kept pace. While many of these complex products were designed to spread out risk, they've often had just the opposite effect, obscuring where and to what degree that risk was concentrated. Regulators and investors need to have a fuller and clearer picture of the risks posed by increasingly complex products, as well as their true value. We should also aim to make more financial products fungible to ensure they can be transferred from one exchange or electronic trading system to another. I believe we need to establish a federally regulated clearinghouse for derivatives or requiring reporting to a central repository. This will create truly efficient, effective, and competitive markets in futures and derivatives, which would benefit investors and the industry as a whole. Finally, today's financial markets are global and interconnected. Our regulatory regime needs to be as well. The U.S. must work with countries across the globe to coordinate and synchronize risk. At Morgan Stanley, we're grateful to everything the federal government, the American taxpayer, did to support our industry and to help bring stability back to the markets. We recognize our industry has much to do and to regain the trust and confidence of taxpayers, investors, and public officials. Thank you.
Thank you, Mr. Mack. Mr. Moynihan.
Thank you, Chairman Angelides, Vice Chairman Thomas, and other members of the Commission. I welcome the opportunity to help provide some information on the important matters you're investigating. As you know, I assumed my role as CEO of Bank of America on January 1st, and prior to that time I ran the consumer areas of the company. In leading our consumer business, I had a first-hand knowledge and a recognition of the hardships that many hardworking families and small businesses experience across America. Together, the financial services companies, our elected leaders, and regulators must continue to work to understand what occurred in the financial crisis and apply these lessons so that it simply does not happen again. Over the course of the crisis, we as an industry caused a lot of damage. Never has been clearer how poor business judgments we have made have affected Main Street. This Commission's work is important because the lessons are not going to be simple. This crisis had a multitude of causes that are not easily summarized. It is important that we understand the breadth of the causes so we can learn the right lessons and apply the appropriate policy to remedy them for the future. We have seen, in our view, 4 crises unfold: a mortgage crisis, a capital markets crisis, a global credit crisis, and a severe global recession. The mortgage crisis originated with a dramatic expansion in the availability of mortgage credit through subprime lending and aggressive mortgage terms, even in prime products. This led to a greater debt burden for consumers. Lenders, prompted by lower interest rates, rapidly rising home prices, and large amounts of capital available, made credit available to borrowers who could not previously qualify for a mortgage, or extended more credit to a borrower who could, or perhaps should, would not be able to handle. The national policy to expand American home ownership was also popular and created tailwinds. No one involved in the housing system, lenders, rating agencies, investors, insurers, consumers, regulators, and policymakers foresaw a dramatic and rapid depreciation in home prices. When a nation did experience this rapid depreciation in home prices, the first that had been experienced since the Great Depression, many of these loans became very unfavorable, and the option of refinancing disappeared, leading to defaults. The second crisis came in investment banks and the capital markets areas. Investment banks not only had underwritten mortgages, but they had retained significant amounts of the risk by holding interest and providing backup liquidity for mortgage-related securities they had sold. Investment banks created products based on these mortgage assets. The risk of these assets spread. This happened when a monoline insurer guaranteed the mortgages or a structured investment vehicle bought the mortgage securities, and happened to money markets funds who purchased the commercial paper from those vehicles. Third, the stress of the financial crisis began to spread beyond the investment banks and mortgages to other fixed income products and to more market participants. This destabilized the financial institutions and non-financial institutions that had little to do with the U.S. or the mortgage market. This contagion was in fact global. Without government intervention to restore liquidity to capital markets, the risk of global economic collapse was very real. The final crisis, and perhaps the most daunting, is that we have a severe economic recession going on. Well, some would say that the financial crisis caused a recession. The experts will analyze that for the coming years to establish the exact causal relationship. But one thing is clear. The U.S. economic growth in the first decade of this century was funded in part by home price appreciation and the ability of homeowners to access the equity in their homes to use for spending. In addition, home mortgage and home equity financing helped drive residential construction activities, which contributed to the economic expansion. The history of past economic cycles and this cycle shows that an economic expansion built on excessive debt or leverage will end in a recession, no matter what triggers it, and this one surely did. This crisis has taught us some very valuable lessons. And let me highlight a few of those that are in my written testimony. First, this credit starts and ends with sound underwriting, a clear assessment of the borrower's ability to repay the loan. Rating agencies or credit bureaus are no substitute for diligent and independent risk analysis. Second, capital is important, and the leverage of investment banks and other market participants was untenable. While the leverage requirements for a bank holding company may have been better, banks and others should, and undoubtedly will, hold more capital going forward. Third, liquidity is the key. Liquidity allows an institution to meet margin calls, fund redemptions, or pay depositors without having to sell liquid assets at discounts, which could lead to further losses. And fourth, current accounting rules need to be reviewed. Current rules require banks to reduce reserves to set aside loan losses in good times, reduce reserves against loan losses in good times and build them in bad times. In addition, mark-to-market accounting can become disjointed when there's no real market for many products. Before closing, let me say a few words about compensation. At Bank of America, our compensation guidelines are set by our Board of Directors. The goal of any compensation program and the program at Bank of America is to attract and retain the talent we need to make the businesses profitable. In 2008, our company actually earned more than $4 billion, but that was far short of what we believe we should have done for our shareholders. Neither my predecessor as CEO nor any of the top leaders in the company, myself included, received a bonus for 2008. For the executives at the next level down, our bonuses were cut more than 80%. Our 2009 compensation pools have not been finalized. We anticipate that the compensation levels will be higher than they were in 2008, but certainly not back to the pre-crisis levels. We have implemented many different programs, including clawbacks and greater deferrals that you've seen referenced in the press and other places. And all of our activities comply with the work that we've done through the various regimes, the TARP regime and the Paymaster Feinberg and others. We understand the anger felt by many citizens because institutions that received federal investments 15 months ago are now recovering and pay their employees to reflect this recovery, especially in investment banking trading areas. In response to that criticism, I'd make a few points. First, at Bank of America, we are grateful for the taxpayer assistance we have received. I'm pleased to report that we've paid back 100% of those funds, $45 billion, along with nearly $3 billion in dividends and other payments to taxpayers. Second, the vast majority of our employees played no role in the economic crisis or losses. They've worked hard during this crisis to help their customers and clients, and they extend more than $750 billion in the 4 quarters leading up to the 3rd quarter of 2009. Third, while some employees were asked to leave the company over the past couple of years, we believe our 300,000 employees are a valuable part of our future, and we need to pay them competitively to ensure that we can keep them so they can help our clients. In conclusion, I want all of you and the American people to know that I fully understand and appreciate the gravity of the crisis that we are now just coming through. We are grateful for the courage shown by government leaders to take bold, unprecedented action to preserve the financial system. We support regulatory reform efforts designed to prevent any recurrence of this episode. But most of all, we as managers have to run our companies never to let this happen again. Thank you for your time, and I welcome any questions you might have.
Thank you very much, Mr. Moynihan. Thank you very much, all of you, for your thoughtful statements. We are now going to move to questions, and we have got a lot of ground to cover, so I'm going to ask that you be as obviously incisive and compelling as possible, but brief, succinct, direct answers. I'll start the questioning today, and what I'd like to do is I'd like to start by asking some questions about specific types of business practices and risk management practices that may have contributed to the financial crisis as a way of making this tangible and real. And I want to pick up on your comment, Mr. Diamond, here. I'd like to be brutally honest. Mr. Blankfein, I'm going to start my questioning with you today. And I want to actually pick up on your comment, your testimony about the fact that there were, and I think I'm paraphrasing this correctly, that there were financial products and practices that may have served no essentially good or productive purpose in the financial system. Recently, you've made a few comments, and I'd like to just read you a couple of quotes. You said in November of last year, listen, there was a lot of negligent behavior, improper bad behavior that has to be fixed and sorted through. We don't take ourselves out of that. I include ourselves in that. You also said we participated in things that were clearly wrong and we have reasons to regret and apologize for. What I'd like to ask you is, can you tell me very specifically what are the two most significant instances of negligent, improper, and bad behavior in which your firm engaged and for which you would apologize? That's a vote.
Oh, I see. I'd say the biggest, and I referred to this in my oral testimony just now. I think we, in our behavior, got caught up in, and this is a general remark, I'll get specific in a second, got caught up in and participated and therefore contributed to elements of froth in the market. So, for example, in leveraged finance, which was our biggest exposure, we are a top service provider to the private equity world. We are a top mergers and acquisition firm in connection with rendering that advice for mergers and acquisitions. We help finance those transactions. Increasingly, those transactions took on higher and higher leverage, which they could not have but for the willingness of financiers to participate in that, and we were a major financier. And moreover, we held those positions for too long, too much concentration in our books. In other words, we sold them down, and if you go through a continuum of people who've had these positions, I don't think, relative to our size, we had more than we should have had, and therefore we had to do, and when you go back and look at them, too much leverage in transactions and too much concentration remained from that leverage on our books.
Okay. Would you characterize, looking back on this now, and obviously hindsight's 20/20, but would you look back on some of the financings as negligent or improper?
Again, in the context of the world that we were in, and when you use terms like that, I always think about standards of behavior, and in the context, I think those were very typical behaviors in the context that we were in.
Let me ask you, have you done any kind of internal investigation, kind of large sweep of your activities, and is that, what did you find, and is that something we could have?
I'm not, if we have something, of course, we will identify it for you and you can have it. I'm not referring to a specific, I'm referring to the fact that we look at our risks and we look at our positions, and in the tensions and crisis area, we looked at that our balance sheet and the amount of illiquid positions on our balance sheet, and that's what I'm referring to.
Well, if in fact you have done an internal audit investigation to kind of look at the practices, the mistakes that occurred, we'd like to be able to have that, review it. Obviously, your attorneys, I'm sure, will want to review it before, but
absolutely,
perhaps something so we can follow up on. Let me move on now. Let me talk about, the issue of conflicts comes up in many respects in the marketplace. Sure. It comes up in compensation. It comes up in compensation, it comes up in trading practices, and I want to ask you about a very specific instance as a way of getting to how things worked and how things might be changing in the future. Based on the review of public documents, as you know, your firm sold a significant amount of subprime mortgage-related securities. And it appears, at least according to public documents and other reports, that you may have simultaneously betted against the securities you sold to clients. According to the reports, you sold about $40 billion in 2006, 2007. December 2006, I think you came to the conclusion the mortgage market was heading south and you began to reduce your own positions. And many of the securities that you sold to institutional investors, other folks, went bad within months of issuance. Now, one expert in structured financing said the simultaneous selling of securities to customers and shorting them because they believed they were going to default is the most cynical use of credit information that I've seen. Do you believe that was a proper legal ethical practice, and would the firm continue to do that practice? Or do you believe that's the kind of practice that undermines confidence in the marketplace?
Well, the way the short answer is, this is the practice of a market maker, and I would like to explain this. But the answer is, I do think that the behavior is improper. We regret the consequence that people have lost money in it, but I just want to explain, and this is a very important, and I appreciate the opportunity to do this because there's so much press swirling around this that I really need to explain. In our market-making function, We are a principal. We represent the other side of what people want to do. We are not a fiduciary. We are not an agent. Of course, we have an obligation to fully disclose what an instrument is and to be honest in our dealings, but we are not managing somebody else's money. When we sell something as a principal, which is what we are as a market maker, the next minute that item will have gone up, in which case we'll wish we hadn't sold it that minute, or it will go down, in which case we'll actually be glad we did for our own P&L and sorry for the person who bought it. But we are market makers in that. In most of these cases, the person who came to us for the exposure that they wanted to have.
But Mr. Blankfein, you are actually creating these securities, and let me just tell you, someone who's been in business half my career, the notion that I would make a transaction with you and then the person with whom I made that transaction would then bet that that transaction would blow up is inimical to me. And I guess the question is, you weren't purely a broker. You were actually taking subprime product, packaging it up, and selling it under your label, correct?
Let me be clear. We were not a broker at all.
Correct.
Not at all.
Okay, you were a principal.
We're a principal.
Okay.
The act, it wasn't as if we were creating product, that product existed necessarily, and we were shorting it. The act of selling it reduced our risk.
Okay.
Let me be clear about
but it was not so, the act of selling. I can understand how. My point was you had a view of the market as you continued to sell the securities. I guess one of the questions I'd ask you is, how do you go to the rating agencies with whom I dealt with a lot as treasurer, and how do you persuade them to give many of the tranches the highest ratings, AAA, at the same time that you have credit information that leads you to believe that, in fact, those securities may fail?
Chairman, I have to, and another point, the predicate of your question. We are not necessarily, I know if you had looked into Goldman Sachs, we were not controlling our risk. When you listen to the testimony that's come by, the biggest problem that institutions had was the accumulation of risk. We weren't working. A market maker doesn't manage its risk profile because it likes housing or doesn't like housing. Those are separate. We have various pockets we have various pockets of Goldman Sachs that like a position or don't like. What we do is risk management. Because we had this risk, because we were accumulating positions, which, by the way, we acquire from clients who want to sell them to us, we have to go out ourselves and provide and source the other side of the transactions so that we can manage our risk. These are all exercises in risk management.
Well, I'm just going to be blunt with you. It sounds to me a little bit like selling a car with faulty brakes and then buying an insurance policy on the buyer of those cars. It doesn't seem to me that that's a practice that inspires confidence in the markets. I'm not talking about your own positions. I'm talking about betting against
of an asset here is an institution, probably professional-only investors dedicated, in most cases, to this business.
Representing pension funds who have the life savings of police officers,
These
teachers.
are the professional investors who want this exposure. Let me ask you, in the current market today, things are
Let's move on, because of time.
I think these are important matters. I think this is one of the most critical questions that are revolving around here.
And then I have a question to follow up on this.
No, I understand. We are sitting here today with people commenting in the press, gee, the equity market is being driven by more bubbles because of the liquidity in. Others are saying the equity market is right and we're in a recovery. No one really knows. Yet people are coming to us as a market maker. I want exposure to the equity market. I don't want exposure to the equity market. We have to make sure the products do what the products say, that they're honest, that they're disclosure, and there are laws that is. But we are an institutional firm, and this is the highest part of the institutional market. Even today, by the way, people are coming to us for exposure to these very instruments, not at 100 cents of the dollar, but 8 cents on the dollar, because they think it's going to be worth 12 cents, and other people are saying it because they think at 8 cents it's going to go to 4 cents. That's what a market is, and our role as a market maker creates the liquidity.
I do know what a market is, but I want to ask you this question. Did you always disclose to every investor that, in fact, you were taking the contrary positions, or just yes or no? Was that consistently disclosed?
the possession doesn't foot. We were selling as a principal. When we sold, we were selling something that we had owned.
Then let me ask you one final question.
They owned it and we didn't.
Let me ask you one final question on this topic very quickly in terms of as a principal, which is in September 2004, the FBI's head of the criminal division warned that mortgage fraud was so rampant in this country that it was a potential quote-unquote epidemic, and that if unchecked, it would result in a crisis as big as the S&L crisis. Did you take any specific steps in the wake of that 2004 crisis to evaluate the mortgages that you were selling into the marketplace?
Well,
and
as
if you don't,
we were not an originator of mortgage.
No, but you were
we
a pack.
acquired mortgage.
Correct.
We are audited and reviewed and subject, and we have due diligence practices that we think were robust. And so the answer is that people can examine what our due diligence process were, but as I sit here, I have no reason to think they weren't robust.
Okay, let me...
Would I do more now? There's no after acquired information I've ever had that wouldn't change my behavior in some respect. Anyone who says I wouldn't change a thing, I think is crazy. Knowing now what happened, whatever we did, whatever the standards of the time were, it didn't work out well. Of course I'd go back and wish we had done whatever it took not to be in the position that we find ourselves.
Let me ask one very quick set of questions about risk. In your testimony, and in fact written and today, you spoke about your risk management rooted in accountability. And today you talked about, of course, none of us know where things are going, so we have to prudently plan for risk. And I think, you know, you make the point that you had profitability in 2008, but I want to press you a little on this because I think it goes to maybe the overall context of risk as it was perceived and hopefully won't be perceived again. At your firm, you tripled your assets almost from about $403 billion to $1.1 trillion from 2003 to 2007. That's an annual compounded growth rate of 29% when GDP was growing at 1 to 3%. Your leverage ratio when measured against tangible equity was 26 to 1. By some analyst measures, 32 to 1 against tangible common equity. You've even made the observation, a couple of folks here, about the dependence on short-term liquidity, which exacerbates that. And then as a balance sheet matter, there was extensive hedging, I assume because of the significant leverage and maybe the opacity or the risk profile of the assets you held. In the end of the day, and I'm going to press you on this, it seems to me that you survived with extraordinary government assistance. There was $10 billion in TARP funds, $13.9 billion as a counterparty via the AIG bailout. By your own Form 10-K, you said that you issued $28 billion in debt guaranteed by the FDIC, which you could not have done on the market but for that. You were given access to the Fed window and the ability to borrow next to nothing. You became a bank holding company over the weekend. You had access to TALF. You benefited from a ban on short selling, which you initially opposed, which Mr. Mack had advocated. And you got relief, some relief from mark-to-market rules, even though I understand you're assiduous about marking to market. I guess when you look at the amount of leverage that you had, and you do look at your rapid growth, do you really believe that your risk management in the big picture was sufficient to have allowed you to survive but for that government assistance, which I laid out?
Well, there's a lot of predicates to that question. The fact of the matter is we were much leveraged now, so you could take that as a vote that we wish we were less leveraged then. But when you look at the leverage of companies and people are throwing out 30 to 1 or 40 to 1, our high watermark was actually a fraction of that, was about 20, which was kind of small. A lot of that included cash on our balance sheet. I think we did a very good management. We had tremendous liquidity through the period. But there were systemic events going on, and we were very nervous. If you're asking me what would have happened but for the considerable government intervention, I would say it was a more nervous position than we would have wanted in. We never anticipated the government help. We weren't relying on those mechanisms. When you think of that extraordinary week after Lehman Brothers, which was the most hard, tense week there was, that weekend when we became a bank holding company, the next day we capitalized ourselves in part privately with Warren Buffett, and the day after that we did a capital raise for $5.75 billion, which you could have made a lot higher. We had access to the capital markets, and we could have made it more, and we weren't relying on that government help. That government TARP legislation came about 3 weeks later. That being said, I don't know. I can't say here and tell you what would have happened, and I know for sure no one else knows either. I felt good about it, but we were going to bed every night with more risk than any responsible manager should want to have, either for our business or for the system as a whole. Risk, not certainty. Even after the TARP was done and all those were implemented, did that exempt us from risk? No. And as you point out, there's still risk today. But the question doesn't have to turn on, would you have gone under but for? Would you have made? The fact is the world was unsafe. The government, regulators, taxpayers took extraordinary measures to reduce intolerable level of risk to a much more tolerable level of risk, and that we should all be appreciative of.
Yeah, and the reason I press this is not to make you say uncle, but you know, in kind of lay terms, what was done at investment banks, different risk profile at the more regulated commercial banks, is extraordinary leverage. I mean, akin to a small business person who has $50,000 in net worth, or a family borrowing $2 billion in some instances, $1.5 million, with much of that money due overnight. And what I'm trying to drive to is whether there's a clear recognition that despite all the risk models, on a fundamental basis, excessive risk was being taken, notwithstanding all the models that existed.
Well, as I said, I concede with the looking now, and again, everything is context-driven, and I couldn't be more clear. After 10 benign years in the context where we were, look, how would you look at the risk of a hurricane? The season after we had 4 hurricanes on the East Coast, which was absolutely extraordinary, versus the year before. Rates got very low for risk premia on the East Coast of the United States. That year after 4 hurricanes, everyone's nervous as such, rates went up spectacularly. They're lower again. But, is the risk of 4 hurricanes any different any of those times?
Mr. Blankfein, I want to say this, having sat on the board of the California Earthquake Authority, acts of God will exempt. These were acts of men and women.
I'm just saying that if you're asking
these
me
were controllable, is my only observation.
I agree. I sit here and read testimony to the effect of reducing our balance sheet, raising capital. Clearly, we are much less leveraged now. Consequently, I wish we were much less leveraged then, even though we were much lower leveraged than others, and we had cash on our balance sheet, and we did better than under those circumstances. But if you're asking me, would I do something differently knowing what I know now with respect to that capitalization? How could you not? Of course.
But I also wanted to put in context the level of risk and the level of assistance, because this is something I think no one would want repeated again. Let's do this then. Let's now move to questions from other commissioners. I'm going to stop at this moment and move to Vice Chairman Thomas. Thank you very, very much.
Thank you.
Thank you, Mr. Chairman. I think context is important. You mentioned earthquakes and how familiar we are in California with earthquakes. Mr. Blankfein, you talked about context. I think as we conduct these hearings and talk about the problems that were encountered and how close we came to a catastrophe, that right now in Haiti, by one of those acts of God, there is an enormous catastrophe. There are thousands of people, and I think the number of deaths will shock a lot of people if you've never been to Haiti or Port-au-Prince in terms of the living conditions that were there, subject to death traps available. I think the general question that everybody wants to ask, and you said it 4 different ways, and I'll put it in the overall overarching way, that if you knew then what you know now, what would you have done differently? That may or may not help us as we go forward. But I said at the beginning that what we've been doing is a lot like an iceberg. You can only see 1/8 of it, 7/8 of it is underwater as it comes towards you. You've been kind to come, and we have a lot of commissioners who want ask a lot of questions. Mr. Chairman, I want to ask of these witnesses, and it will be applied to all of the witnesses, that we have a very limited opportunity at this time to ask questions. We would very much like to submit written questions to you and receive those answers. The other thing, this commission is also subject to, if you knew then what you know now, would you ask different questions? We're only around for most of this year. We have to conclude our work by the end of the year. Obviously, you start with fact-finding, you begin coming to conclusions, you collect those conclusions, and we will publish our findings after the end of this year. But the questions that we would ask now perhaps wouldn't be as insightful or appropriate or useful as questions we would ask 3 months from now, 4 months from now, based upon our also informing ourselves. So I would like the request in terms of submitting written questions to be applicable during the entire time that we operate. As the Chairman said, you may or may not return to us, but I do hope you'll be willing to be available, notwithstanding not being available in person, to continue to assist us in our job of trying to explain to the American people what happened. Is that something that's acceptable to you, gentlemen?
Yes.
Yes.
Thank you. And in trying to form questions, I know there are a lot of people who want to be in one of these coveted chairs in terms of an opportunity to ask a question, and I'm sure there are those in the room representing the media. In fact, I think we have an excellent example in this morning's New York Times, and it was also in yesterday's New York Times, of people who, if they don't own, they have available ink by the barrel, who decided that they would ask their own set of questions. So, Mr. Chairman, my questions to begin with will be those that were submitted by the New York Times, and we would ask you to answer those in writing, and then, in fact, give everyone in America, Mr. Chairman, the opportunity to be in that same position. And I think it's most appropriate to tell anyone who's listening, watching, or hopefully will read anything about this hearing today, that the opportunity to submit written questions to who it is that you wish that question to be submitted is an opportunity that ought to be available to all Americans. And so, Mr. Chairman, I take this opportunity to say anyone who wants to write me, Bill Thomas, fcic.gov, and submit a question, we'll do the best we can to get you the answer. More importantly, the greater number of people who ask, and the broader the questions, no matter how trivial in terms of some pundit's point of view, it's a question the American people want answered, and I think that will be part of our job over this year to answer those questions. So we may be back to you not with our questions, but with questions that have been supplied to us by people who perhaps thought that some of the answers were, some of the questions we're going to hear today weren't the ones that they would have asked. Mr. Chairman, this is relatively unusual because usually we will close the record after a period of time. Given the job we have and the time in which we need to do it, I would ask unanimous consent, Mr. Chairman, that every hearing's record remain open, that questions submitted either during the hearing or submitted to us, I'd kind of like to channel it to those that are submitted to us, because if we open it up, every editorial every day will be a list of questions that just came up, but we can handle that as well. Our job fundamentally, charged by Congress, was to get to the bottom of what happened, but most importantly, explain it in a way that the American people can understand it. We have assets with you gentlemen in front of us. We'll have additional assets. We need to utilize all the resources available to produce the document, which we hope will assist Americans in understanding what happened, primarily for the purpose, as you indicated, Mr. Blankfein, to know what we should have done had we known now what we knew then. And our job by the end of this year will to be smarter, to ask the best questions we can, but to rely primarily, Mr. Chairman, on every American's opportunity to sit figuratively in this seat and ask the question they would have asked. And that should be agreed to by everyone. And I will then begin channeling those questions that come to us. And obviously, as I said, the first questions are on page 827 of this morning's New York Times. Thank you, Mr. Chairman.
I will now call on the commissioners for questioning. I'm going to start with Ms. Murrin.
Thank you, Mr. Chairman. My first question is to Mr. Blankfein. A question for you about AIG. Could you talk a little bit about when the government supported AIG and enabled them to close out your exposures to risk at AIG? Did anyone ask you at any point to take anything less than 100 cents on the dollar?
I never got a request myself about taking less. It didn't come up in any conversation that I can recall. Subsequently, somebody in my organization who was going back and forth with some of the. This was after the AIG. This was a couple of months later, at the time when they were closing out a portfolio called, I think known as Maiden Lane 3, told me that he got a question to the effect that at least contained the inference that he drew. Would you be willing to take less? And he said he couldn't answer that question now himself at his level, and he then said it never came back up again to him, and as I said, it never came back to me.
Did he further that question up the chain of command at your firm at any point?
I think he, I can say I didn't get it. I didn't get it. He might have told his boss.
Could we talk a little bit about your interactions with the regulators? In particular, when you think back on the events of 2007, 2008, there are obviously a lot of people that participate in risk management that are either internal or external at your firm. There are regulators, there are auditors, there's internal audit, there are your external auditors, there are committees of your board. At any point, did any of those entities or individuals raise the issue of the quality of the assets on your balance sheet or of the leverage that you had at any point during 2007 or later?
We're a mark-to-market firm, and we have businesses, important businesses, we have distressed businesses. We have businesses that specifically go out and buy distressed assets, but they're marked correctly. So our auditors wouldn't say, I like this asset, I don't like that asset. Our auditors would say, is this asset appropriately marked? And we engage on them, and I think I talk to the auditors each time, and they tell me we do a very, very good job. We not only mark them, we go out and, to the best I can, get external benchmarks and go out and test the marks. So it's not a matter of, we will today we would go out, and if a client came to us and wanted to sell us a very distressed portfolio, Lehman Brothers debt, or anything like that, we would have a bid for it. That's our role in the market. We'd buy it. They could get it off their balance sheet. We'd have it on our balance sheet, but it has to be marked correctly. That's the real issue. Is it marked correctly?
And it sounds like you have quite a bit of discretion in that regard, and that it doesn't sound like there was a lot of challenge to the kinds of marks that you were making.
Oh, I'm sorry. There is huge challenge in our organization. We spend a lot of time. Our control system.
I was referencing outside of your organization, specifically your auditors or the regulators.
Oh no, they go over our books and records. It's a very, very long process. They not only audit the marks, they audit the processes by which we get the marks, and they test them.
So then, do you think that in light of what's occurred, that they were doing a great job?
I think they did. You know, again, I'm living within I'm answering within the scope of my knowledge. I mean, I don't engage with the audit process. I get a summary, or I talk to the audit partner, and I'm a member of the board, and so I receive it there. So there's limits to what I can tell you in assessing them, but we're quite satisfied. We're satisfied with our auditor. Otherwise, we wouldn't have him.
And the regulators as well?
Well, we went through an evolution of our regulators. I mean, obviously, we were regulated during the period. We were regulated by the SEC as our primary regulator. That was an institution that came in with the last few years, where you had one main regulator, and then that regulator, of course, switched when we became a bank holding company, which would have been in the fall of '08.
But it is their responsibility, am I correct, to help you determine what risks you may or may not be undertaking as a firm. Is that right?
I would say help to determine what risks. I think of it is that they surveil us, and we, in the first instance, would try to do something. We're always disclosing to them what we think. It's a ongoing process, not that we do something, they look at it, we engage them. There's an open, and this is the intention of the process, to be engaged, but then they look, and very critically, if they didn't like it, they wouldn't let us do it, or would stop us from, I mean, that's their role.
And
but
do you think there should be more surveillance in that regard, and more supervision of the kinds of activities that are undertaken by investment banks?
Well, first of all, there's been a clear demarcation between the sociology, for example, of our regulation before and after becoming a bank holding company. So before that, with the SEC, which was kind of new as a prudential regulator, I say the regulation of the Fed is a lot more, a lot more apparent, and I mean, every day, dozens of people from the New York Fed come to work in our building, not as employees of Goldman Sachs, but as employees of Fed. But this is their place where they do business, and they come in and they know every part of our business, look at papers, our processes, procedures, and so it's a different, our regulation is different now.
So is there a yes in there, that there should be more regulation, more supervision?
Well, there should have been more than there was in September under the old regime, and right now, given that we're still catching up, this is our first year under the Fed, I can't assert that it's not enough. It feels much different. It feels like a lot of regulation, and appropriately a lot. I can't say now that it's not enough.
But things, do you feel as though they've changed and they're better from a regulatory standpoint? They're improving?
I think we have a very, very tough regulator. I can't tell you whether they improve, because to us, it's a new regulator, not necessarily to everybody on this panel. Because, again, we acceded to this regulator as a result of becoming a bank holding company in September '08.
Thank you. I have one final question, Mr. Chairman.
You have time.
I was struck, actually, by, you mentioned several times that your behavior, either individually or as a corporation, was really within the context of what is considered standard for the times. And given that we're now in 2010 and we have unemployment at very high rates, foreclosures are high, many people are really suffering right now. Given that these are the standards of the times, could you please comment on your compensation and that of your senior executives?
First, as to the standard, I mean, I'm not. What I meant to convey is, I'm not sure. Again, I haven't surveyed what the standards of the time were, but let me say, and people will go back and test this, I'm sure, and look, I know the standards of times were different than what we are now, and so the way I was asked that question, how do you rate yourself in terms of negligence of what you should have done, I'm just saying it would have to be compared to what the standards were. Those standards, when you look back in hindsight, should have been elevated. And by the way, that could also be another source of of incorrectness. Maybe we should have been a part of those who elevated those behaviors. But that's what I meant to convey. I wasn't saying that those were fine. I'm saying when you ask me what the standards were, again, that's how we would measure ourselves in terms of what we were thinking. Now, you asked me a question.
Thank you for clarifying that, but the question that I'm asking really relates to where this country is economically. And also just, I noticed that in your 2007 annual report that accountability is listed as one of your firm's core values. Sure. How can you reconcile these things given what's going on in the country economically? And do you feel that your compensation adequately reflects your firm's behaviors, what the standards of the times are? And do you think that you have a compensation structure in place that will hopefully reward people for taking a longer-term view as opposed to maximizing their short-term profitability?
Commissioner, the last compensation we did, which was in 2008, and we haven't announced our compensation yet. Our year ends. We announce our results for our year next week. But I think in 2008, which was a cycle which we already went through in the heart of this downturn, we took our firm-wide compensation down, and this includes people whose compensation is hard to take down because they are secretaries and staff. Our overall compensation went down 50%, about 50%, which was in line with which was in line with our performance. The senior-most people in the firm were down 80%, that group, and the named executive officers, myself, the COO, the vice chairman, the CFO, the bonus was down 100%. We took no bonus. And I think, given the circumstances, that was quite appropriate. And so that, as far as our structure, we have always had our work, and if you look at the history of our compensation, the compensation always correlated with the results of the firm, as it did last year, as it did last year, and that's something that emanates. We've been a firm for 141 years, but it's only the last 10 years that we've been a public company. We've been a partnership where clearly everyone in the firm had all their wealth, all their accumulated compensation stayed in the firm virtually until they retired, and everybody got paid in an ownership interest in the firm. And most of our people, all senior people, get the predominant amount of their compensation in shares, and that's been true for years. And we've just even ratcheted that up to the point where our senior committee is only getting shares.
It's an interesting point you raise about the change in your structure, because there are some who would say that now, as a public company, that there's more of an incentive to take excessive risk because it is no longer a partnership structure, and thereby the risk is shared by your shareholders, not so much necessarily the partners of the firm. And also just, I believe, if I'm not mistaken, that your compensation was not down as a percentage of your revenues last year. So two-part question.
Well, I think the firm's compensation was down in accordance with the revenues. I didn't say in excess of the revenues. I said there's an exceptionally close correlation.
And the partnership structure?
And the partnership structure, we still have the people in the firm, the partners, get paid. A lot of their compensation is in shares. Most of the senior people, of the compensation of senior people is in shares, and that they have to hold. I am obligated to hold 75% of those until retirement. Actually, post my transaction with Warren Buffett, 90%. So I would say the people of Goldman Sachs have their results correlated with the success of the firm.
Thank you for answering my questions.
Mr. Thomas has a follow-up on his time, very quickly.
Did I understand in terms of your answer that you're now providing compensation in part in shares?
Well, we always
always did
provided, as a public company, when we had shares. Prior to having shares, partners only got paid in interest that they had to keep in the firm, except for a stipend in effect.
Okay. Mr. Diamond, in terms of the question that was asked of Mr. Blankfein, could you give us a before and after if there's been a change in the compensation structure? Have you changed your compensation after the quote-unquote downturn to require some equity time prior to receiving the...
So recently you saw the G20 and the Federal Reserve and a lot of people brought up compensation principles, which we generally agree with, but we have always had the following principles, that senior people get paid a lot of their compensation in stock. It's generally been 50 to 75%, higher for me. You have to maintain ownership of that stock, 75% of it, as long as you're part of the senior management committee. We've had certain clawbacks. It's always been risk adjusted, so we look at the amount of risk you're taking before we actually necessarily pay that compensation. And we don't have things like special change of control, parachutes, special severance packages, things like that.
Mr. Mann?
We've always paid a large portion of our compensation in equity. We've increased it for the most senior people up to 75%, which they have to hold. The only thing new we've done, sir, is we put a clawback provision in now. So some of the bonus we will have access to up to 3 years. If a trade turns bad into the new year, we'll be able to go in and take that back. That's been the big change.
Mr. Moynihan, you've got a new position, but you're not new, so you can tell me about B of A.
We've had a tradition of paying in stock. Likewise, like Mr. Mack said, in our firm also for this year, we've instituted clawbacks to better match the duration of the risk. So if somebody does today, we can look at 2 years and actually claw back against their compensation.
And both of you said instituted this year. That means that's an ongoing change in your compensation, not just for this year.
It's part of our compensation scheme, but paying in stock has been part of our compensation scheme for a long, long time.
Thank you. Thank you, Mr. Chairman.
Thank you, Mr. Vice Chairman. Now, Senator Graham.
Thank you, Mr. Chairman. My questions go to the issue of incentives. Incentives are the things that are intended to shape or direct behavior and performance. We've talked some about the form in which those incentives are taking. I'm interested in what are the underlying goals of those incentives. Mr. Mack, you said that you closely link compensation to performance. What are the primary elements of performance to which the compensation is linked?
Well, number one, I think the first criteria we look at is clearly profitability. And then as you go from profitability, you look, if you go into the sales and trading area, which most of these questions are focused on, is how much risk they take to have that profitable performance, how much interface they have with other senior members of a sales and trading operation to make sure communication is what it should be. We also look at the interface that our sales and traders have with our clients and what kind of interface is that. And most important, one of the things that we look at is how do our risk managers, and these are risk takers, how do they interface with our risk management team? These are people who report directly to me, do not report to sales and trading, but oversee the soundness and safety of the kind of risks we do take. And under that, we have put a lot more resources, Commissioner, into that process and put a number of people to work in creating models to make sure we can monitor that risk. So if you go to risk management as an example, you say to yourself, clearly given what we've been through in the last few years, that individual needs to be paid who runs risk management not on profitability, but needs to be paid on safety and soundness. Is he or she doing their job to make sure that we're not taking excessive risk, that we have liquidity in our risk positions? So when you say how do you pay, you need to go department by department. So many departments, if they're support areas, let's take the IT function, where we're doing a lot of work, especially now that we report to the Federal Reserve, in building our models and building the ability to measure the kind of risk we take on our balance sheet. So they're paid differently, but they're paid on what do they produce and how quickly they get it online and does it work. But broadly speaking, each group within the firm has certain goals depending whether they're support services, marketing services, risk management services, or trading services. And then, again, we could go into investment banking, how we look at each one of our bankers.
From your answer, I got the impression that in the risk area, for instance, that most of the measures of performance are process. Do you then go back and assess whether that process actually resulted in greater or lesser risk, and that those outcome measures become part of performance?
We definitely go back, and one of the things we've done recently, sir, is created a separate risk committee of the board where risk management will report to them. Risk management, we do look at those processes, we do evaluate them, but more importantly, those are decisions that are almost instantaneous. So as soon as a new risk comes on the books, it's the responsibility of risk management to analyze the impact it would have on our value at risk. How much risk are we taking? Are they liquid? So the answer to you is yes.
I guess my question is, from your testimony and the testimony of your other colleagues this morning, some of those decisions, by virtue of time, have been shown to have been excessively risky and put the financial system, contributed to putting the financial system in the shape that it is. Have those actual outcomes of risk analysis, particularly where they were turned to have untoward outcomes, did they become part of the performance evaluation?
They did, but again, as the chairman said, we want to be brutally honest. There's no question that we had not put enough resources into our risk management system.
Yeah. Do any of you in your performance standards include aspects that are external to your own firm? One of the justifications for your role as an intermediary is that, for instance, you are wise people in determining how to allocate resources to the benefit of the overall economy of the country. Do those kinds of considerations, how much have your decision makers contributed to economic growth, job creation, those things that affect the general economy? Are they part of the performance measures?
Well, clearly, given what we've been through and the pain that homeowners are going through and people losing their homes, we have been very direct in our mortgage area to make sure, and I think I gave you a statistic that we're about 44% with all of our mortgages that we hold, have renegotiated the payments. So in that aspect, the answer is yes. But when you look at some of the automobile companies who we have loans to, you know, those loans are made based on how much risk we're taking. We know those automobile companies or other industrial companies need loans, but we also have a fiduciary responsibility to make sure that we have done our due diligence, and it's not the same social push as we do in home loans and our mortgage facilities.
In terms of evaluating, and maybe I'll turn this question to Mr. Moynihan, as among potential sources of investment for growth, how do you then relate those judgments as to the compensation of the executives and other personnel responsible for making those decisions? For instance, there's concern that maybe an excessive amount of capital was placed in the housing market to the detriment of other areas of the economy. Is that a factor that is considered in your performance evaluation?
I think a specific factor, I'd say no, no, sir. But in terms of generally how we build our financial plans and how we think about how we grow our business, we make allocations of capital, and then one of the goals of an executive or a person working is to make that financial plan, and that so it indirectly factors in. But specifically, we don't relate someone's individual performance into a broader social question of how to allocate capital in the financial system.
How, in retrospect, looking back over the last decade, how effective do you think your performance standards have been and the compensation that they have generated to achieving goals of your institution and the broader economy?
I'd say that, like my colleagues, we could do a better job of aligning, really, in some areas, the time frame at which a risk can be taken on by a decision today that could come true or not down the road. We've also do that through the holdbacks of equity and clawbacks that we'd have in other areas, like credit card, where you make underwriting decisions today and they turn out to be true later. But that is one of the changes that we've made in the incentive plans as we for 09 and 10, and it will continue to hold, because I think we learned a lesson over the last several years that the nature of the underwriting, it takes time to figure out whether a decision made today comes true, and that's the clawbacks and stuff we put in. So we're trying to address that, sir.
Senator Graham, 1 minute.
Yes.
1 minute.
Well, one last question to Mr. Blankfein. Your firm, about 10 years ago, changed from being a partnership to a publicly held corporation, and now you've changed again to a bank holding company. How have your approaches to performance evaluation changed, or have they, as you have changed the structure of Goldman Sachs?
I think we've, owing to becoming a public company, I think we stayed and tried very hard to keep the partnership ethic. So, for example, there are elements of our compensation scheme that might be a little different. It suits our culture and it suits our history. It might not suit everyone's. So, for example, no one at Goldman Sachs gets paid solely out of his or her own performance. Not traders, not salespeople. Everyone gets paid partly on the basis of the firm as a whole, their business unit, and of course we take account of their own performance. But the object for us is to keep going with that spirit of partnership and cooperation and teamwork, and also, by the way, an incentive for everyone to surveil everyone else around him or her, because we make everybody co-responsible for each other. So that's it. That would be a distinctive element of our structure that wouldn't be. But in terms of metrics and looking at it and scrutiny, it's like we try to keep it. The big change for us is not becoming a partnership. It's becoming a much bigger global company where there are we still call them partners of Goldman Sachs and staff in Beijing and far-flung places, whereas 20 years ago clustered around some American cities and maybe London, maybe Tokyo.
Just one last question. Has the percentage of your total revenue, which is distributed in compensation to your partners, changed as the legal status of Goldman Sachs has changed?
In the status situation, in the old regime, everything that was left over belonged to the partners. They were effectively the shareholders. But I'll say, in the 10 years or so as a public company, we have been, we started out and said to the world that we will start looking at the beginning of every year like it would be about 50%, and it's just gone, and it's largely gone lower. Largely gone lower for the good reason that our revenues had often gone higher, and so you didn't need to pay as much. And in the overall effort of what to do, one of the problems that I think we have is what we do a lot for the economy isn't that visible as an investment bank. We help allocate capital, we raise, we put companies together, we launch new businesses by raising capital in the process, but it really doesn't interface a lot. It doesn't interface enough with the people who we would want to understand what our role is in the system. And so recently, we've embarked on a program which we call 10,000 Small Businesses to try to get Goldman Sachs to apply itself to that issue, to deal with something that's on a dimension that's close to what's needed for the current moment.
All right, I'd like to move this along. Thank you very much, Senator Graham. And on my time, I'm going to ask one follow-up question to Mr. Mack with respect to the Senator's questions, and that is, just very succinctly, what's the pay structure and amounts for risk managers versus traders? I mean, what's the kind of ratio?
Well, I would say that we've been very clear, especially in 2008 when we changed our head risk manager, that happens to be a gentleman who many years ago was a trader, that he can make the same kind of money that our best trader can make.
But that has not been historic.
Historic, that's correct.
So going
that
forward,
is a change.
All right, thank you very much. All right, let's go. Thank you, Mr. Holtz-Eakin.
Yeah, I want to pick up on that and ask a question a little more broadly of the whole panel. Each of you in your testimony talked about problems of managing risk and excessive risk. Mr. Blankfein talked about underpricing of risk that led to massive leverage across wide swaths of the economy. Discussion from Mr. Diamond about compensation practices and misjudgments about aggressive underwriting standards. Mr. Mack talked about not having sufficient resources to manage those risks. And so each of the institutions you represent are publicly traded. They have audit committees, they have boards, they have internal auditors. And so my question is, what is it about this traditional structure that failed us? Why is it that the risks that you have identified weren't uncovered in the moment? And what specifically has each of you done, in addition to what you've discussed, to change your risk management practices since the crisis? Why don't we just start, Mr. Blankfein?
You know, I think if I had to say one thing in specific, and we focus a lot of efforts and always have on risk management, and our senior risk managers rise to the highest level, including our named executive. One of our named executive officers is our risk manager, so at the highest level of the firm. I say the one thing that we constantly learn from every crisis, 98, tech, this one, of course, which is a different level, is the need for more stress tests. Very often in our business, we go through the analytical process of what could go wrong versus what is the probability of that going wrong, and therefore tend to discount the consequences too much. What a stress test does, it says, don't tell me that this is unlikely. What if it did happen? But it's not going to happen. What if it did? What I learned after so many years in the markets is, given enough time, not everything can happen, but everything will happen, and therefore implementation of more stress tests.
So you've done that as a
yes,
as a firm?
Constantly.
And are these essentially of the type that we saw the Treasury conduct?
No, it's a little bit different. So you read in the paper some anxiety over whether the emerging markets are having a bubble. So we look at that. We may read in the paper, we may feel it swelling up, we may see it in the pricing of some assets, and it's far on the horizon because actually we're quite positive in our research about emerging. But we said, okay, what if? What are the knock-on effects? What are our exposures to those places? What are our exposures to those places that have exposures to those places? And we go through a process of going around and assembling, okay, assume this happens. And we constantly, through our risk committee, are doing those kinds of things, which both help us to avoid problems, but also tells us what to do if something happened. It won't be the first time we've considered it.
And the stress test process would be audited in the usual fashion, disclosed?
Well, a lot of this has to do with our own internal risk committee functions. We obviously describe our risk committee, but this is an ongoing organic process.
Right. Okay. Mr. Diamond?
I would say if you do everything right in business, you are going to make mistakes. And you really have to look at the continuum of how many, how big. Even if you do it right, you'll make some. Hopefully, they'll be smaller and won't be threatening to your institution or anybody else. And the process is very rigorous. You know, if you look at, we have risk, we have a separate pricing group, it's internal audit, external audit, and it's reviewed by the OCC and the Fed. I think when you have a chance to look at those things, you'll be pretty impressed with the diligence behind some of that process. As a company, we always did some stress testing because history tells you that things go bad in the markets, and you have to be prepared. That should never be a surprise, and you don't know exactly what's going to go bad or exactly what direction it's going to come from. When you look at a business, and it's partially answers the question that the Senator was asking too, we look at a whole balanced scorecard. So it's not, you know, if you are not financially successful, you fail. So it is obviously a sine qua non of doing business, but it is not the most important thing. So if you were running a business for us, we say, are you building a great company for the future? Will you be proud of it? Is it sustainable? Are you building better systems, better processes, better people, better training? So we look at the whole thing. It is never driven by one metric, and I think you can get make mistakes doing that. And looking back at some of the mistakes, I also think as a business, you have to look at what you did right, what you did wrong, and if you're not continually analyzing and improving it, you will not get better. So I've already mentioned the biggest mistakes we made in mortgage underwriting. Somehow we just missed, that home prices don't go up forever, and that it's not sufficient to have stated income in home prices.
If you'd been doing, you had been doing stress tests prior to the crisis.
Yep.
Did you do a stress test that showed housing prices falling?
No, I would say that was probably one of the big misses. We stressed almost everything else, but we didn't say home prices going down 40%, and that's now part of the stress test.
Okay. Thank you. Mr. Mack, you've answered about beefing up the resources of risk management, but if there are other things you'd like to know,
let me just add
how the traditional system failed.
Well, just to add a couple things. Our head risk manager sits right by the CEO, our new CEO, James Gorman, on the floor, so there's a real link with risk management and the most senior person in the firm. The other thing I just want to comment on, and this goes to Commissioner Murin's question earlier to Mr. Blankfein, I think with the Federal Reserve now as our lead regulator, the amount of focus and scrutiny that we get on risk, not just outright risk, but the systems around risk, models, how we test the models, even to the point if we want to make an acquisition or make a major move, they're involved and ask certain questions that is very new in my 40 years with this new regulator. So I would say that I'd give high marks to our regulator and how, I don't want to use the word intrusive, how diligent they are in our risk and how we manage risk.
Thank you. Mr. Moynihan?
I think, much like my colleagues, we have an independent risk management function and have had. And if you ask what we thought we missed, I think it'd be similar to what Mr. Diamond said, which is, if you think about it as we support the broad economy and what we do, so we have, yes, we have investment banking and a larger one now, but the mistakes we made, the most losses we've taken have actually been in credit cards and mortgages, and that was just where we kept originating prime assets too deep into the economy, and we didn't do the kind of testing you actually do in a trading book, saying, what if housing goes down 40%, and test what your thought would be, irrespective of the probability, just how you'd protect your firm. And I think that's probably the best lesson we've learned out of this crisis, and we'll apply it. When you actually look on some of the commercial lending side, we had felt that in the 89, 91, and so therefore we had to practice that. On the consumer side, we didn't have those kinds of practices, and I'd say above all, that's what we've actually implemented, and we'll continue to make sure we are diligent about.
So you have, at this moment, stress tests that look at commercial real estate and the concerns that are out there now. Yep. And picking up your exposures.
We have, and as you said earlier, the work that was done last year about this time to put in a stress test and things like that are broad firm-wide stress tests, but we've always had a view of commercial real estate really through the hard knocks taken in the late 80s and stuff to be very diligent about what it could happen to. I don't think the consumer side had ever seen this kind of recession, and that led us down a path that we've learned from.
A lot of this revolves around housing, and I want to pick up on something in your testimony, Mr. Blankfein, where you said, if I have this right, that almost all of the losses that financial institutions sustained over the course of the crisis thus far have revolved around bad lending practices, particularly in real estate. Can you tell us exactly what those bad lending practices are, off the top of your head? What are the list of things that were bad? Need your mic.
In the consumer area, business is clearly all that's been written about origination, and Jamie referred to stated income without tests, and I'm sure he can pick up that cudgel and talk about on the consumer side. On the more corporate side, I would say it had to do with leverage, and it had to do with terms, covenants, conditions. The markets got more competitive. There was a sense that the world had a lot of liquidity, and so the commodity of money got less scarce and people paid less attention to it. And as a consequence, people were lending to support transactions, which is a business that we're very familiar with, that had more multiples of debt for the equity, and the conditions that applied, the covenants, the maintenance, the things that allowed a lender to intervene in the company became more and more lax. And so you could intervene less. So that lack of rigor on the transactional side, I think, had its counterpart in the consumer side and on the commercial lending side, which others here are more familiar with.
Were you aware of this at the time? Did you see the standards going down? And if so, how did you highlight this in your risk management?
In all honesty, we did know you cannot miss the fact that the covenants are getting a little lighter and that the leverage is getting bigger. With the benefit of hindsight, I wish I weren't in the position of having to explain it. But at the time, I know we all rationalized the way a lot of other people had rationalized, gosh, the world is getting wealthier, technology has done things, things are more efficient, there's no inflation, things belong low, these businesses are going to do well. And I think we talked, much as a lot of the world did, talked yourself into a place of complacency, which we should not have gotten ourselves into, and which, of course, after these events, will not happen again in my lifetime, as far as I'm concerned.
Mr. Chairman, I'd like to extend an additional 3 minutes to the Commissioner for his questioning, if he's interested.
Thank you. If I could, I wanted to follow up with another piece of your testimony where you said something to the fact that, essentially too many institutions outsource their risk management to the credit rating agencies, and ask you specifically, did Goldman Sachs do that? Did it test the rating agencies' ratings? Did you look at products that were rated highly and do internal scrubs? And what was your experience in that area? You've highlighted in your testimony. I'd like to know how Goldman looked at that.
I think we did some I could think, I'd like to talk at the places where we were scrupulous and scrubbed ourselves, but,
I'm asking about the others.
I think there were instances where we also deferred, not necessarily you're the only judgment. It was our judgment. You can't, just the same way you'd say you can't blame a regulator, and we wouldn't. We can't really blame a regulator for an credit agency for a decision that's our decision to bear the consequences of. But I would say I would be more complacent when I saw something had AAA than if it had a AA, or a AA than it had a single A. So to that extent, I also must have been deferring to a rating agency.
And with the close of my time, I'd like to just ask Mr. Diamond to go back to the mortgage underwriting and your observations on how so many bad mortgages could be written in the United States, right, and the decline in lending standards.
Right. So it's really not a mystery, and it's kind of surprising. High LTV, a long time ago, you did 80% loan-to-value loans. With proper appraisals, it went to 85%, 90, 95, 100, even higher than that. Second is, in the old days, you have to verify your income, show a tax return or a pay stub, and make sure the income was there. And there was more and more reliance on FICO scores and people saying, I earned this. The third is that it went lower and lower in credit. So call it subprime, Alt-A, but basically, as these things taking place, more in credit. And you never saw losses in these new products because home prices are going up, people are making money, and in addition to this, I think it's also true there were some bad products and some bad actors and excess speculation.
Can you talk specifically about the bad products and bad actors?
Well, I think as it turned out, option arms were not a great product. I think certain subprime Alt-A products weren't great products. I think there were some unscrupulous mortgage salesmen, mortgage brokers, and some people missold, and there was a lot of speculation. Far too many people buying second and third homes using these things as opposed to the place they're going to live.
Thank you, Mr. Perrin. I yield back my time.
Just a quick follow-up on my time, and that is that I mentioned earlier in September of 2004, the FBI made a clear warning about the level of fraud in the marketplace. And Mr. Diamond, you indicated in your written testimony, I think again today, that you excised most, I thought it was all, but I heard today most mortgage brokers from broker-originated lending from your practice. And you were seeing default rates of 2 to 3 times. Just very quickly, and it's a yes or no really for the balance, did any of you excise broker-originated mortgages from what you were securitizing, packaging, and selling to the market?
No, we were securitizing broker-originated mortgages.
No. No, not that I'm aware of.
Did you not have the data?
We were late in that process of securitizing product, and the only way we did sampling and testing, but we did not exercise anyone who after the fact has come out were giving us faulty data. We did have the right, Mr. Chairman, when we found faulty data or faulty mortgages, to put them back to the originator, and we did that.
All right, but okay, I'll leave it there. Thank you. Let's now move on. Thank you very much, gentlemen. Let's move on to Mr. Giorgio.
Yeah. Gentlemen, I'm a strong believer in the strength of the market system. And although regulation of the financial services industry is proper and necessary, despite their best efforts, government regulators often lack the resources and expertise to monitor adequately activities that create undue systemic risk. So it is important for us to focus on creating market mechanisms that reduce the likelihood that risk-taking practices will get out of hand and threaten the stability of the entire financial system. Expert commentators have suggested that the crippling financial crisis was at least partially caused by inadequate accountability of those responsible for the creation of financial instruments for the consequences of their action, because they lacked, quote, skin in the game. The investment bankers who undertake the fiduciary duty to conduct due diligence on the integrity of the security, the lawyers who draft the prospectuses, the accountants who audit the financials of the issuer, and the rating agencies which rate the safety of the security are paid their fees all in cash from the proceeds of the sale, and thereafter suffer no financial consequence whether the security succeeds or fails. This system places the burden of loss exclusively on the purchasers, often pension or retirement funds investing on behalf of citizens who worked a lifetime, legitimately expecting that there will be sufficient resources available to fund their monthly benefits during retirement. It has been suggested that this lack of accountability could be remedied if all the firms and individuals involved in the creation of financial instruments had to, quote, eat their own cooking, requiring, for example, that their fees be taken not in cash, but in significant part in the securities they created, which they would be required to hold until maturity unhedged. So if a bond were issued that was to pay 7% interest per year for 5 years, then repay the capital investment, the originators would receive their compensation on the same basis. If the investment banker who led the underwriting was entitled to a $1 million bonus, he or she would receive the $1 million worth of securities, yielding $70,000 per year in income for the 5 years, receiving the $1 million in cash at the end of the 5th year. If the security failed to perform as represented, just like the investors, the originators would lose their expected annual income and the expected principal amount of their bonus. Alternatively, some have suggested that investors should have a put for 18 to 30 months, during which time, if the security failed to perform, investors would be entitled to a refund, requiring the issuer and the underwriting investment bank to buy back the financial instrument. These suggestions are in no way intended to punish the responsible individuals, but rather to improve the quality of the diligence they exercised in the origination of the security, knowing that their financial future, just like that of the purchasing investors, is tied to the success or failure of the security to perform as they represent it will perform. And I would ask each of you whether you think that the volume created of illiquid toxic securities that contributed significantly to the global financial crisis could have been materially reduced by some such mechanism of placing financial responsibility where it belongs on those who originate financial instruments. And I would respectfully request that you attempt to answer, not as leaders of 4 of the world's most prominent financial institutions focused on maximizing your firm's profits, but just like the commissioners on this panel, as Americans struggling to identify the root causes of this devastating financial crisis and potential remedies to avoid its repetition. Mr. Mack.
Happy to answer it. First of all, just on some of the product and the mortgages, we did eat our own cooking and we choked on it. So we kept positions, and it did not work out, not necessarily the position specifically, but that part of the industry, the housing market. Number 2, the idea to be paid in stocks or bonds for payment, I would do that, but I think it would be an issue with investors. Today, if we get that kind of payment, or in the past when we've gotten payment, especially with startup companies, we've been criticized for holding back stock. It should be all distributed, especially if it's a successful transaction. But as an industry point of view, you know, if I'm paid in stock or I'm paid in bonds, that would not be an issue. I like that idea, but I think it would create some issues with investors. As far as your idea...
I'm not sure I understand that point. Maybe you could elaborate.
Well, let's say we have the next Apple computer company, wherever it may be. We do the underwriting. Instead of getting paid in cash, we get a certain amount of stock. The stock was hugely successful, went up dramatically. I think people would want to make sure they have access to invest in stocks like that or bonds that also do well. The SEC in the past has been pretty clear that when we distribute securities, and especially when they go up, we do not hold any securities back. They're all distributed to investors. So I think there could be a debate about should we be paid in equity or should we be paid in fixed income instruments.
Right, but you're customarily paid as a percentage of the issue when you engage in an underwriting, and so why couldn't that percentage of the issue simply be in significant part in the securities themselves, which would permit you to benefit substantially were it to rise, but would also permit you to lose substantially if it went down, just like the investors do?
Well, again, I would welcome that. I think you would have to give us some leeway because markets are volatile. If markets are to go down, some way of hedging that. Other than that, I wouldn't mind being paid in equity or in fixed income.
Well, but the problem is that the hedge itself undermines the whole notion of the concept, which is to place responsibility on you, the underwriting, the originator, the party that has the greatest access to the information for the success or failure, ultimately, of the security, just like the investor.
But if you are a very large underwriter of either new issues or fixed income, and we've just gone through a week of record issuance in the corporate bond market, you very quickly would fill up our balance sheets, and you would have us in a situation that would have to curtail our business. So there has to be some way to adjust it. Now, it could be a shorter period of holding the securities. That may work.
Yeah.
But again, I'm not opposed to it.
Or it might require more capital raising on your part to expand your business.
Possibly, but we've raised a lot of capital and have very high Tier 1 ratios. It could.
Right.
The other part about a put back to us, you mentioned if the security does not perform. Again, there is a short period of time. Oftentimes, if there is information that comes out right after a new issue has been priced, there are times that new information comes back and there is a put back. But to extend that over a long period of time is putting all of the risk on the underwriters. And some of you broadly, not the panel here, may think that's the right way to do it, but that would curtail our business dramatically and I think hurt the capital markets in the United States and also on a global basis.
Mr. Blankfein, could you comment on any mechanism
Sure.
to put on the originators some responsibility for the
Look, I think it would be hard to organize. I mean, we don't directionally trying to put some of the more onus on the issuers, on the originators, is probably a good idea. Some of these elements, you can go back and forth on. I think the way the origination process and syndication process is designed, we're not supposed to be in conflict. We're not supposed to have a stake in it. In other words, if we were going to originate a security and we were going to end up with some of it, we would have an incentive to have that security sold at a lower price than the higher price. And a lot of the securities laws are designed to make us not have a conflict with the client that's originating. But that's neither here nor there. If the overall theme is, should there be some skin in the game, that could be a theme worth pursuing. The issues that John Mack brought up are all considerations that would have to take account of. Clogging up balance sheets, having a conflict with your clients, because now all of a sudden you're not just someone trying to find the right price between a seller of a security, the person who needs the capital, and the investing public. You're now a member of the investing public, and so those things would have to be sorted through. The other point that he made earlier, how effective is that in terms of influencing behavior? In this process, most of the problem wasn't, in my opinion, the cynicism of companies which held these positions even though they knew they were toxic, and motivation. They didn't know they were toxic. Why else would some of these balance sheets of some of these companies have many tens of billions of dollars of these securities? It was a failure of risk management, I think, more than a failure of incentives. That's just my, for
Right.
most of
but
these
wouldn't,
things.
But wouldn't
Mr.
the,
Giorgio, you have 20 seconds. Very
but
good.
wouldn't the underwriter, wouldn't the entities, the originating entities, be in a better position to know whether these securities had the possibility of becoming toxic? For example, if you, as you evaluated some of the CDOs that you created, wouldn't you be in a better position to know whether they were likely to fail?
Again, if you should be in terms of your knowledge, you should be in a good place both places. In terms of incentive, I can't think of a bigger incentive than having $50 billion of this stuff accumulating on your balance sheet.
Right.
And they had that incentive, and it didn't work.
Okay.
I think it was a failure of competence more than incentives.
Let me just ask one question. Some of you talked about clawback provisions. Have any of you actually utilized your clawback provisions? And I wondered whether each of you, since I don't have time to hear your answers, I wonder whether each of you would undertake to advise us in writing of whether you've actually applied the clawbacks to people within your firms without naming the particular person, but how much money you clawed back from them, what percentage of their compensation it was. And if you could provide that in writing, we'd appreciate it very much.
Terrific. We're going to now take literally a 5-minute break, if that would be desirable. But let's make it 5 minutes and get on back and get on with our business.
Notwithstanding any commercials you may have seen on TV, it has nothing.
Wimpy. Poor Wimpy.
Got it. That's what I got. That's what I got.
Beneva, where's Reggie?
Every day. Got nothing to do? You got to stand awake for this. Absolutely. I would like the stock. I didn't pay us the stock.
There's legislation they're talking about reform. Is keep. Oh yeah, part of the legislation that passed the House would require. It was 10%. They brought it down to 5%, with some flexibility.
Wow.
Depending on. That's what they do.
What were they doing? Securitizations.
Yeah, well, that's what he's talking about. Everything.
Well, he's talking about everything, but the SEC has been really tough on being paid in kind.
Well, but I think your answer was good, because if we're not gonna pick and choose where we're gonna do it. We're just gonna.
Well, it's the securities price itself.
Do you feel as if you're in court here today?
Now, listen, they have a job to do. I think it's important. I think in many ways, we all have other things to do, but this is really important to be able to participate and give our views. I think we're very lucky to have the chance. There are changes that need to be made, and I think it needs to be talked about. So I don't feel like I'm in court.
And do you feel any pressure of public anger on Wall Street?
Oh, I think, listen, as long as you have unemployment in the 10% range where it is, and people lost their homes, there ought to be without question, you feel that. Sure.
What do you think about the state tax idea of the
I haven't reviewed it yet. I just read about it the last couple of days, not looked at it. I've been preparing for this, so I'm not ready to make a comment on it.
Do you think that Wall Street is tone deaf in preparing so much more bonuses now this week to these problems you mentioned?
Listen, I think clearly Wall Street has to be much more attuned to what's going on in the economy, especially in the U.S. economy. And I think progress has been made. I mean, one of the reasons that I said to the board I did not want a bonus is because I am attuned to it, and I think other firms are too. We put in a lot of things in place to make sure that we're responding to what's going on. But again, as long as as long as there's high unemployment and people are losing their homes, it's going to take time. We got to fix that.
So what are the American people supposed to think when they read about the big bonuses going to, executives of the banks?
Well, at least with me, it's zero. All right. So I'm not taking a bonus. So let me just talk about it. Well, look, I have to run a company. All right, and we've had a record revenue year. I've got to keep people in place. And if you go back and you look historically or look in the last year during all the turmoil, a number of people have left, not just Morgan Stanley, but Goldman Sachs, other companies, to go either to other banks or to private equity. So there's still a very big market out there of demand for talented people. So we have to find the balance between what's prudent to run your business at the same time being responsible to what's going on in the economy. And I think with a lot of this compensation being changed from cash to equity that vests over 5 years, 6 years, and also most of us have put in clawbacks where there is some transaction that loses money the next following year after you've been paid, that you have the right to take that money back. So I think by and large firms are really trying to respond to that.
So you think that balance has been struck?
Well, again, I think we're in an environment so difficult, you can never strike the perfect balance. But the effort to do that, everyone is very focused on doing that.
Why do you think there's such a resistance to write down the principal of mortgages to keep homeowners in their loans, especially since a lot of the modifications aren't working out as well as a lot of people thought?
Yeah, I think a lot of that, I mean, just in our case, we have a very small mortgage origination company called Saxon, and I think we have restructured, is it 46% or 44%? 44% to keep people in their homes. So there's a real effort to do that. I can't comment on the bigger companies. I don't know what they're doing, but there is an effort to do that.
Modifications?
Are there?
They're trial modifications as part of the HAMP program.
So we are making progress on that.
I mean, there's been reports that a lot of those trial modifications are not going on to become permanent and aren't necessarily going to keep people from going into foreclosure.
Well, look, you got to start somewhere. We started. I think we've been aggressive on it, and we want to be very sensitive going forward. If we have to extend it and it makes sense to do, we'll try to do that. But we need to be responsive.
As of now, you're not thinking about agreeing to write down principal?
Well, I think the most important thing is to try to redo their you want to let your hand rest? It's begun to shake. We've tried to be very responsive. We'll continue to work with the homeowners to keep them in their homes. All right, you guys are forcing me to go take a break. I was going to stay here and talk to my guys. Thank you.
What are you doing after you step down from Morgan Stanley?
Well, I'm no longer the CEO. I'm the chairman, and I'll focus on clients. And if I can help, this committee or any of the regulators and some of the issues that I see that can be helpful, I'll be happy to do that.
Do you think other Wall Street CEOs should not take bonuses like you did?
I think people have to make their own minds. I don't know. All right.
Get out of this meeting?
Well, this is just the first. This is the first meeting. I think a lot of people are going to end up coming here. I think this is just the first cut. So, thank you.
Yeah. No, I get that. But well,
If everyone in the audience can please take your seats. Mr. Vice Chairman, we're going to roll forward now. Okay. Mr. Thompson.
Thank you, Mr. Chairman.
Mic on.
Thank you, Mr. Chairman. I'd like to take the discussion, if I might, back to the causes of the financial crisis. And as I reviewed the written testimony of several of you, particularly Mr. Blankfein, in your testimony you said that there were products that were created that served no purpose. What were those products? Why did they get created? Why weren't they regulated better? To what extent did those products that had no purpose contribute to this problem?
I'm not sure.
I think you're referring to SIVs.
I think I was, at that point, I think I was talking, maybe I was talking about SIVs or those off-balance sheet. I think that there was regarded as a kind of an arbitrage, if you will, to have a company or a trust that invested in longer-term assets and financed itself short in the commercial paper markets. And that is a mistake that is as old as financial markets to make, that liquidity would be there, and ultimately those risks contained in the assets that were acquired and the vehicle was structured in a way to keep the risks off the balance sheet. But when they blew up, they suddenly came onto the balance sheet of institutions and created a lot of uncertainty as to the solvency of the institutions that sponsored them.
So we saw a collapse a few years ago of an organization that took down an awful lot of people and collapsed two companies, Enron and Anderson, where underneath that were a set of instruments that were off-balance sheet financed items.
Yes.
And many, many statutory changes were made to govern organizations to make sure that they didn't do things like that again. How could that have occurred in such a massive scale this time?
I think in my written testimony, when I cited that issue about off-balance sheet risks, I said, post-Enron, that is amazing. This was the line I used, not because these things haven't happened before, where people had risks that they weren't showing, which, by the way, creates two problems. One, whether you have profits and losses in your own business, and two, an uncertainty of the people who deal with you about whether you're solvent or whether anybody in the world is solvent, which froze the system. I think it's quite a big lapse that that happened. We, as a mark-to-market firm, because of our regimen, we are required to put everything through our P&L, whether or not it's on our balance sheet. If there is a risk, if we make a commitment before it's even a security, we have to mark that commitment to market. And so our regimen that we were always under wouldn't have allowed us to do that, but it created a lot of problems for some of the big banks and sponsoring institutions and for everybody else. Because not only did it affect them, but it created this wave over the financial markets where there was insecurity about whether anybody could be trusted.
While it certainly would suggest that risk management might have lapsed, it also might suggest that corporate governance lapsed just a bit in terms of the interactions between the audit committee and the board and the veracity, if you will, of the work that was being done to determine exactly what the quality of the book was. So to what extent does financial innovation and the regulator or even organizations' ability to keep up really put this economy at risk?
Well, I think there's always, the answer is it does, and the question is how do you moderate the risk, or how do you cover the risk, or how do you, let's apply the word excessive to prudence instead of excessive risk. How do you take such prudence that you can allow for risk, but you build safeguards and conditions and liquidity and a lot of capital around it? Because you don't want to, it's the age-old problem, you don't want to fail to innovate on the other one hand, and on the other hand, you don't want to bear the consequences of innovation that goes poorly. And so that is a balance that has to be reached, and you'd like to reach the best balance, again, before the 100-year storm, not the day after the 100-year storm, but that, I think, is going to be one of the most important uses of the information that's gleaned from this, from the work of this commission, is how do we reset the balance, but also making sure we don't go so far that we so de-lever the system, if you will, or so take no risk that we lose a lot of the engines that drive growth in the economy. It's a challenge.
So, Mr. Mack, you indicated that you've had a 40-year career in this industry. How would you suggest going forward we think about innovation and managing the risk associated with innovation? Because you've seen a great deal in your time.
Commissioner, I think it's, in many ways, it's very simple. I think our regulators and the industry have to focus on complexity. Instruments today can be so complex that even though, let's assume I am a salesperson at Morgan Stanley and you run a pension fund or insurance company, you and I understand what you are buying. And then a year later you move up. I move over to a different role. Someone else takes your job. How difficult is it to get into the structure of that instrument? Now, clearly, people are qualified and smart enough to do that. The question is, does it happen? And I've said this to Chairman Bernanke, and I've also said it to Barney Frank when I visited with him. I think we do need to look at complexity. It continues to jump higher and higher, and of course, with innovation and computers and very smart people, you can continue to make it complex. So I think one of the things that the regulatory framework needs to focus on is complexity.
So can the regulatory framework adapt or adjust fast enough given the pace of innovation in the industry?
Well, I think, again, I've said it and my colleagues on this panel have said it, we do need a regulator who has more resources and more a bigger budget to focus on that and attract people into that arena to focus on it. But yes, they can do that, but it needs, again, we have many different regulators. I would like to see some consolidation. I would like to see a kind of a head regulator, not just here in the U.S., but tied to other regulators across the world in a global economy. And I think if you had the super regulator, and again, it's a new experience for Morgan Stanley to be reporting to the Fed, but I got to tell you, the amount of questions that we're asked, and Mr. Blankfein said earlier that every day people from the Fed are in his building, the same at Morgan Stanley. I find that very helpful. It's a great check and balance. And certain things that we think we can do, they say, if you do that, let us tell you how we're going to look at it. Now rethink it.
Well, there's the old adage that if it sounds like too good of an idea, maybe it is. And perhaps some of this oversight is management's responsibility, not necessarily that of the regulator. So, Mr. Diamond, to what extent would you put the onus on you and your management team, not defer that necessarily to the regulator?
Well, I think I started my opening statements by saying that I blame the management teams 100% and no one else. So that does not mean we shouldn't look at what gaps there in regulatory system. So if I was the regulator, I would say there should be no gaps in the system. There should be more authority to deal with certain types of more complex situations. New products should always be reviewed and aged. But I don't think it's unique to financial services. New products have problems. And, you know, give it a little bit of time before people leverage up on it. And so I think that it's really the responsibility of committees. And I think most of these things can actually be fixed pretty quickly in a thoughtful way, you know, as you go through your work and you see where, you know, all the flaws were. One of the surprising things about all these things, a lot of the things we all talked about, mortgages, SIVs, derivatives, they were all known. They were not a secret out there. No one put it all together. There was no systemic regulator trying to look around the corner and say, well, if a money market fund has a problem, that's going to cause a problem for X. It's not a mystery. It's not a surprise that we know we have crises every 5 or 10 years. Mm-hmm. You know, my daughter called me from school one day and said, Dad, what's a financial crisis? And without trying to be funny, I said, it's the type of thing that happens every 5 to 7 years. And she said, why is everyone so surprised? So we shouldn't be surprised, but we have to do a better job looking forward, no regulatory gaps, you know, better disciplines in some of the companies, eliminate some of the off-balance sheet stuff that helped facilitate some of the problems.
One more. On a longer-term basis, some say that our country has had more of its human capital diverted to financial engineering as opposed to mechanical engineering or electrical engineering or engineering of real products that over time really make the economy competitive. To what extent that has the compensation structure of the industry attracted away the true raw human capital and made this economy weaker from its perspective of delivering real products and services into the marketplace?
That's me?
Yeah.
You know, I think probably a lot of talent has gone to financial services. I think you really got to ask almost macroeconomics how talent moves and why it moves. I don't know. I know a lot of talented people who, my brother has a PhD in physics, and he would never even pretend to want to get involved in something so mundane as trading. So, you know, different strokes for different folks, but I think you probably will see a change over time. That talent will go into a whole bunch of other fields, and you have seen it. You've seen it with the Googles and technology so I think that'll continue. The trend will probably reverse at one point.
Okay, thank you.
Great, thank you.
Mr. Thomas.
Could I ask a quick
yes.
follow-up question? In terms of the complexity, there's more and more drive with documents that the public deals with in terms of trying to put them in plain English to a certain extent so that you can understand them. I know sometimes it's difficult to put it in simple terms, but don't all of them focus on who gets what, when, and how? And you can permeate that in any way you want to, but there are some fundamentals that don't have to be there, that sometimes complexity is impressive. I mean, if I said I hate you, you get it. If I said I have extremely strong feelings of animosity, some folks may not. Now, maybe the blow has been softened by that, but the fundamentals are the same. To what extent can you folks, even from a PR point of view, talk about simplification so that people can understand, or is it kind of an agreement that you're going to have a fraternity which gets paid highly and has the jargon? We run into that a lot in government. I used to run into a lot in government in which jargon was used to reduce the number of people they had to interact with. Is that the case in terms of some of the complexity that you find now? You get paid more for 100 pages than you do for one.
No, that is not. It's more of the engineering, instruction, and derivatives and synthetic products. It's not about 100 pages instead of one page. Certain products answer certain questions or problems that someone's trying to solve for. So all of us are lucky to have very smart people, and if there is a problem that an asset manager has or a pension fund, and you try to work with them to solve that problem as a result.
Is each one unique, or can you run to a standardized structure on those quote-unquote problems? It's something about who gets what, when, and how.
Well, it's a combination. One of my colleagues used the word earlier, bespoke. Some of these products are tailored just for a specific problem, but others are generic and can be used across many different fields of investing.
And bespoke always costs more than the general. Thank you, Mr. Chairman.
Thank you. Mr. Hennessy.
Thank you, Mr. Chairman. I want to focus on the too big to fail question. And just a comment on the selection of the panelists. I think it's interesting that we're talking about risk management with the 4 firms that survived, whether that was because of your risk management practices, but I'm much more interested in hearing about risk management practices at Lehman and Bear Stearns and Fannie Mae and Freddie Mac, the firms that actually failed to manage their risks and went under. But I think the American people probably really don't care about risk management practices at Home Depot or Caterpillar or even the biggest firms like Walmart and Chevron, because if those firms fail, they go under and they go away and their competitors swoop in. But I think that a lot of the policy problems and a lot of the political blowback comes because there was, at a minimum, a perception within the government that we could not allow the largest financial firms to fail. because of the broader consequences for the economy. So what I want to do is first I want to focus on the perception of the too big to fail question, and it's a question for each of you, on both investors and on managers and your board members. And that is, in the fall of 2008, do you believe that investors that were investing in your firms were pricing in the possibility that the government might come in and provide assistance, that the government might decide that your firm was too big and too interconnected to fail? And then the related question is, as you talked with other firm managers and with your board members, did the possibility of the government coming in and rescuing your firm or preventing your firm from failing enter into those discussions? I'm much less interested in whether your firm was likely to fail than whether you think investors thought your firm was likely to fail and whether you were discussing with others, well, if things get really bad, we can always count on the government to step in. And it's a question for each of the four of you. Since we've been starting from my left the whole time, why don't we start from my right and work our way leftward?
Well, I think in terms of discussions, again, I wasn't party to those discussions, but I think, as Mr. Blankfein said earlier, in the darkest days, all of us had to go to bed thinking, if this thing doesn't stop, what could happen? And we all were very concerned at that time. In terms of your view of what investors thought about our companies, I think if you look at spreads in our debt and from, say, August of 2008 and into the first quarter of 2009, you'll see that they widened out dramatically. And therefore, the investors would take a position that they were requiring a substantially different yield, multiples of the yield that they required prior to the time the crisis really hit in earnest. And if you look at preferred stocks and other things, you'd see the same. The yields reached, in some cases, I know, at least as high as 30%. So I think the investors actually are pricing in a deep discount. What they individually did, you'd have to ask. You could get panels of investors to say, but during those tough times, I don't think any of us in the industry didn't think about the ramifications of what could happen if the liquidity and stuff was not at least just restored in the system in some regard.
I think after Lehman was allowed to fail that no investor, at least in Morgan Stanley, was thinking we were too big to fail or the government would come in and help us. As a result, the stock traded at one point down to $6.71. If they had a view that that was not the case, the stock would have never gotten that low. So I think Lehman sent a wake-up call to any investor out there that the government was here to help you and would get you through this crisis. At the board level, it was never discussed. It was never discussed if we get into where the Japanese were not going to put the money that they invested in with us, would we be bailed out by the United States government? It was never discussed, never thought about.
You raise a very interesting question because at no point before the crisis did the market price these firms like they're too big to fail. And all you have to do is look at what they paid for
Mr. Diamond, would you move the microphone closer to you?
Yeah,
I'm getting signals. It's very difficult to hear in the back.
I can't move it any closer, but I'll sit up here. I'm saying at no point in the market before the problem started were these firms priced like they were too big to fail. So if you look at what people lent money to at the firms, no, they were priced like there's potential for failure like any other company. Even after things started failing, and the government, and remember, they did allow firms to fail, like Lehman, but there was IndyMac, WAMU, virtual failures in Wachovia, Bear Stearns. Even after they let things fail, that was true, and even after the government did the stress test and said they don't want these things to fail, the market still priced them, their stock price and their debt, like they could fail. At our board level, we never had a conversation ever that we should rely on government to do anything.
We never had, I don't recall any internal conversation among the employees or with the board that about what we would do if we would fail. I'd say on the too big to fail issue, I agree about the sequence. Nobody in our company entertained government intervention, and certainly certainly we didn't behave that way. We're shareholders. We work for the shareholders, the equity, even in the context of a too big to fail. If you take Bear Stearns, that was, quote, rescued, the equity failed. And we work for the shareholders, and all of the people in the firm are shareholders, and that's how we think internally of what constitutes a failure. So for our purposes, they rescue the debt and the equity goes. That's as much of a failure as anything could possibly be. External, I think everybody contemplated that the equity could go to zero because that was the pattern. And in fact, it's an interesting, and I would say on the debt, after the government, after you saw the too big to fail noise came out, which only came out after Lehman, not before, you could see debt spreads contract a bit. But it's interesting because there's always unintended consequences. Our shares didn't go down to the lows until, for us, after Buffett, we did our capital raise the week after we became a bank holding company at 123. We went down to a low under 50. That was after we got capitalized privately and after the TARP got passed, because at that point, people external to the firm started thinking they'll be quick on the trigger, the debt will get saved perhaps, and maybe the equity will get crushed. Maybe we'll get into the scenario of a kind of a Bear Stearns. And so we were running, in other words, that put some pressure on the equity of our shares, which again went to those lows after the government inserted money into the firms.
Okay, thank you. Related question, and why don't we go this direction now? The capital purchase program and the stress tests drew a line between the 19 or 20 largest firms and everybody else. Do you think that drawing that line has changed that perception in the market? Do you think that investors now believe, well, because my firm was a part of the capital purchase program, because they were a part of the stress tests, because the federal government clearly stepped in and saved at a minimum the financial system and in fact certain specific firms, that there is an implicit put option in the value of your firm and those other 15, 16 firms?
And by the way, I'm just going to say there's 2 minutes, so if answers can be brief for Mr. Hayes.
Yes, that feeling, I would say we don't behave that way, but that sentiment is in the eye of the person who you ask, and maybe some people think like that. I think, by the way, post-Lehman, which, by the way, was obviously allowed to fail, and these conversations and the debates in Congress and the toxic reaction to rescuing these firms, I think that's gone a long way to unravel the idea that the government won't let a big institution fail. And away from the context of a big systemic risk like we had where it was critical, I think any one of these, a firm can fail now in the context that we're in now a lot more easily than it could have at that moment.
Okay, then let me ask a different but related question, which is, do you believe that if one of your three counterparts here, if one of your three counterparts messed up and that firm failed tomorrow, do you believe that policymakers would step in and prevent that firm from failing?
I think tomorrow, in the context of this environment, at some level, the government would intervene. I don't think the equity holders, the shareholders or the employees who own shares would find any relief from that. But there would be something done because of the fragility of the system today, I believe.
Okay.
A year ago, a year and a half ago, maybe not. A year from now, maybe not.
Okay. Quickly, I believe Mr. Diamond mentioned support of resolution authority, some sort of wind-down authority. The rest of you, views on resolution authority, how is that important in legislation?
But, Mr. Chairman, I'd yield the gentleman three additional minutes to be able to pursue the line of questioning.
I'll start. Sure. Yes, I think similar to Mr. Diamond's comments, I believe the resolution authority is key so that we don't have it left to people's speculation of what might happen. There's a clear path forward, as has been in the FDIC process for years and years and years.
We agree with that also.
We don't want to. We would like not to have the too big to fail context prevail.
Okay, but on the specific question of should legislation incorporate some form of resolution authority?
Yes, I'm sorry. Yes.
Okay. Then can you explain to me the difference in views? I was in the administration, and clearly there was a view that there were systemically important financial institutions. We now hear the Secretary of the Treasury, we hear the Chairman of the Fed, we hear other people talk about systemically important financial institutions, a higher level of regulation, a higher standard for preventing them from failure. Presumably that is because I know past policymakers, and I believe current policymakers believe that we cannot allow your firms to fail. What is the gap then between your perceptions that you described from 2008 and the perceptions of the policymakers? Mr. Mack?
Again, and I think Mr. Blindfein said it correctly, somewhere in the future, I don't know if it's 1 year or 2 years, clearly any of these institutions could fail. I think given how fragile the markets are, not just here on a global basis, I think that's an issue. So as you go forward, and when I say go forward, I'm not just talking about the U.S. economy, I'm talking about the global economy. Everything is interlinked. And some of the problems, you know, if it could be just isolated to the U.S., you could probably get there faster in pulling away this idea of a safety net. But unfortunately, it's more complicated than that. And I think that regulators or leaders either in the Fed or the Treasury have more insight to what the global problems are and the risks on a global basis. And as they work through it, and there are a number of meetings going on now, as you know, trying to figure out what is the right template to have, I think down the road that this safety net that many believe, and I believe at least in this particular time frame, is in place, I think that will evaporate and will not be needed. But there's a tremendous amount of work that needs to be done. What we all have learned, and not just through the crisis, these markets are connected around the world. And some event in one part of the world can have huge impact on here in America, or what we do here impact somewhere else. But it's going to take a lot of work and due diligence to come up with the right framework where we can remove the safety net. But I'm convinced that will happen.
Just an observation. I think
time, Mr. Hennessy.
Just 15 seconds. There is a significant difference between an increase in the perception that your firm will fail and whether or not a put option exists. They may both be the case. It may be the case that your spreads increased significantly after Lehman failed, but there might still be investors still might be pricing in the risk, the possibility that the government would step in and rescue your firm. Thank you.
Thank you, Mr. Hennessy. Mr. Wallison.
Thank you, Mr. Chairman. I'd like to focus on a couple of things, a few things for all of you that relate specifically to what caused the financial crisis. The newspapers have covered this somewhat, but I'd like to get it in the record.
Excuse me, Mr. Wallace, would you pull that mic down,
Sure.
Make it more directly toward you, and then pull it up? I know it's hard, but it allows us to hear you.
I got it. Mr. Blindfein, I'd like to start with you, and incidentally, I'd like to say that we W's always envied you B's because you always went first. But in this case, I don't think it's something to envy, and I've now recognized the downsides of being a B. But in any event, let me start with you. The newspapers have covered this quite a lot, but I'd like to get it in the record, as I said. If AIG had been allowed to fail, what would have been the consequences for Goldman, and why?
You know, this is an issue that's subject that we hear, obviously we hear a lot about. So much about it, by the way, that we put an explanation on our website where it sat for a couple of months as to what happened. But we had transactions outstanding with AIG. Because of the protocols of our risk management, we had margin arrangements with them.
These are credit default swaps you're talking.
Credit default swaps. The positions over time eroded with the result that they owed us a lot of money. They owed us and paid, literally gave us the cash in our possession with respect to the mark-to-market loss. I'm sorry.
Well, go ahead. Finish. But
With respect to the difference, we held the cash. During the pendency of this period and through 2008, we were marking to market, as is our regimen, and we were probably one of the most aggressive markers to market because that's our regimen, and we called them for more margin, and they became very slow in giving margin, such that there was a gap. As a result of our protocol, which doesn't allow us to take more than a certain amount of risk, we went out and bought our own protection against their credit, such that the combination of literally the cash we had and the credit derivatives we had from other big financial institutions with whom we also had margin arrangements, so we had the cash for them, effectively covered what would have been the loss.
What was the total coverage that you had?
We had on the exposure of about, and again these numbers are more specific and available, and so I'll do the best I can, are about $10 billion of exposure, against which we had, I believe, about $7.5 billion worth of cash, literally cash, and $2.5 billion of credit protection. Now, maybe that cash is marketable securities, but they'd have been agency or government securities, cash-like.
What were these credit default swaps covering or insuring you against? What was
against
the nature
a default by an event of default by AIG, to my best.
Not the ones you bought, but the ones that AIG was originally covering. What kinds of assets were they? Were they what people call toxic assets? Were they CDOs? Were they backed securities?
They were, and again, I think there were a lot of assets, and some of the elements of our business with AIG was with other parts of AIG and included other thing. But to the point, I think the main part of it were CDO-like pools of securities.
Okay, so you were holding such as investments. These were not in your trust.
Well, actually, we had. And again, I don't want to get too far over my skis on the technicality of a bunch of these things.
But you'll answer these in writing.
Yes.
And afterwards.
Yes.
I assume.
What they were, as I believe we had given protection to another counterparty and acquired that protection from AIG. So in effect, we had no real kind of equity risk, but we did have a credit risk to AIG because we were required to perform on one side.
Sure.
And we needed them to perform.
So you
on
hedged yourself with AIG in effect.
Correct.
Is that what you're saying?
Correct.
Okay. Since Goldman was regulated by the SEC, which I think began in about 2004, your leverage increased substantially from 2004 till about 2008. Why would leverage increase after you became regulated by the SEC?
You know, I don't have, the way we did leverage, the way we looked at leverage, under our regulatory regime, there was a notion of adjusted leverage, which didn't rate every asset the same way. So, for example, right now we sit here with a balance sheet of about $880 billion, but about $170 billion of that is cash, but it's on our balance sheet. So we assign a very low risk to that, and the regulation assigned a low risk. So we had notions of, our metric was an adjusted test. The Federal Reserve for bank holding companies has a gross leverage test, which again, I don't want to misspeak, but we never really focused on, and even at this moment, I don't think is as important as the risk-adjusted leverage test, because how much capital do you have to have against cash?
I fully agree, but the leverage tests have been published in the newspapers, not tests, but leverage numbers have been published in the newspapers. People are under the impression that the investment banks became very highly leveraged after the SEC began to regulate them, and I'm trying to get at the question.
I'll have to get to you what our leverage was at each time, but the investment banks, as a gross term, there was comments, and I read some of the materials, 40, 60 times leverage. I think the high watermark of our leverage, which we never sat at, I think was in the mid-20s ever, as a high watermark, for example.
All right. In consistent terms, though, what you were leveraged before the SEC began to regulate you and impose Basel II on you?
Yes, we are now, and today we sit here literally on a gross basis with about half of our high watermark.
Okay, thank you. Mr. Mack, would you answer the same question, and that is, at least there have been reports that the investment banks became much more highly leveraged after the SEC took over regulation in about 2004 and imposed Basel II regulations. Could you respond to that, why that happened, or if it didn't happen, see if you can explain why these allegations are out there?
I think it happened, but I don't think it was tied to the oversight of the SEC. I just think you had a robust period of low interest rates, and a consistency movement in markets on the upside, so people took more and more risk. But I don't see the connection. We'll be more than happy to go back and look through our files and talk to my general counsel and try to give you a more specific answer, but I'm not aware that that was a trigger point for more leverage.
Back to you, Mr. Blankfein. When was Goldman, in your knowledge, first alerted to the fact that there were serious problems with subprime mortgages?
I would have to look back. As Goldman Sachs, I just wasn't at all focused on it until it started getting into the press.
Well, again, I'm going back to newspaper reports that Goldman was early in recognizing the dangers here and began at that point to sell short against certain indexes in order to protect itself. Was that not?
No, let me be clear. First of all, we had research which we make available that showed Goldman Sachs, published research to the world that showed that we were very negative on the housing markets, I believe, going back way before 07 and 06. Our movement in the mortgage market was for us a matter of hedging and managing our risk, because as a syndicator of product, we were usually in a position of finding ourselves long, much like the banks that have had big problems and accumulated tens of billions. Our risk management protocols required us to try to sell down those positions or else stop being of service to the clients who wanted to syndicate their pools of loans. And so we were driving ourselves from a point of view of let's moderate our risk. People are using the word going short. What we were trying to do is get closer to home, because we were for the most part had long, almost like every other financial institution would have had a lot of this stuff. We were always trying to get back into a risk limit.
Okay, thanks very much. Mr. Diamond, you said that residential mortgages were, quote, poorly underwritten. I think you implied that one of the reasons was that there was so much money around and losses were not being suffered. But, and that is probably true. But were there any other reasons that traditional mortgage standards, such as an 80% loan-to-value ratio and so forth, were eliminated, eroded over time in this period of the 2000s up until the mortgage meltdown?
Mr. Chairman, I yield the Commissioner 3 additional minutes.
Oh, my goodness. Okay. Time does go fast. Go ahead.
So, I think the standards eroded over a long period of time, and the losses were masked by the fact that home prices were going up.
Right.
And I think the whole industry, all of us just eroded those losses. And I think economists will look at, and so I think you've seen the same things I see, the low rates help fuel it a little bit and maybe help fuel a lot of housing speculation. And I've always looked at Fannie Mae and Freddie Mac as being part of the issue in how they grew and over time. I don't blame them for the bad behavior of our underwriter banks, but I do think they were part of the problem for the whole industry taken as a whole.
Let me ask a question of Mr. Moynihan in my very limited time now available. What is, in your view, proprietary trading, and was Bank of America, that is the bank and not the holding company, engaged in that activity?
The rules of the Federal Bank, National Bank, are such that well, flip it around. We conduct our securities activities in a securities company, much like our colleagues do.
That's an affiliate. That's not the bank.
It's owned by the holding company and an affiliate. Right. Yes. Proprietary trading is going to be one of those things that you hear a lot of talk about, and you can try to define. But I think when you offset a position, you're doing it for the firm, as Mr. Blankfein's been describing, and you can say it's proprietary, but it's actually managing a risk. And so I think one of the challenges with some of the thought processes are out there about the ideas of regulating proprietary trading inside a bank holding company are going to be what is proprietary and what's customer driven. and then what's between the two. So if we do an interest rate derivative to help a middle market customer cap their interest rate obligation so that they know that they have a fixed rate of interest in the future, we have to then offset that, because for the same reasons we can't carry one side of the trade, we have to offset that. So then we go out and put on the other side of the trade that is proprietary in that it is offsetting that trade, and it's us engaging the counterparty, but at the end of the day it's to manage the risk so that we can provide that middle market customer with fixed rate so they can have the certainty to run their business. And I think that's going to be the challenge, and I think with good engagement by our firm and other colleagues and the industry, we can try to be more specific, but it is a very difficult task.
Well, I'm just trying to get at one question, and that is there a trading business, a proprietary trading business in the bank rather than in the holding company?
The assets are in the securities firm generally. We can answer that on written submission.
Please.
But basically, our securities activities are in our securities company, which is the affiliate.
Thank you.
Terrific. Thank you, Mr. Wallison. Ms. Bourne.
Thank you. I'm going to address first issues regarding the enormous and unregulated over-the-counter derivatives market. Your institutions are 4 of the largest OTC derivatives dealers in the world. The Office of the Comptroller of the Currency has reported that in September 2009, you collectively held over-the-counter derivatives positions of more than $230 trillion in notional amount. Your positions consist of more than a third of the world market in over-the-counter derivatives. Mr. Blankfein, in your written testimony, you've stated that standardized derivatives should be exchange-traded and cleared through a central clearinghouse, and you further state, quote, "This will do more to enhance price discovery and reduce systemic risk than perhaps any specific rule or regulation." I would like to ask your opinion of the role that over-the-counter derivatives played in causing or contributing to the financial crisis.
Now, I think people may have different opinions about this, but I would say that the aspects of the over-the-counter derivative market was a very, very big concern and a big worry, so much so that a lot of institutions, all of the institutions here, I believe, were working very, very hard to make sure that the plumbing, that things would settle, that things would clear, and that we started the process of creating these clearinghouses well in advance of this particular crisis, and really glad that we do. I mean, it was highly publicized at the Federal Reserve of New York, created a program to get people to just make sure that confirms were done well, and that was a very big concern. As it turns out, my belief is that the derivatives market functioned, over-the-counter derivatives market functioned actually pretty well under the circumstances. Now, the risks that may have been embedded to them, to the extent that they had credit in them, people made bad credit decisions because of, and some of those credit decisions were taken in derivatives, some were taken in terms of securities, but the derivatives market itself actually worked better, I think, than we had a right to expect. And if you could call anything lucky in the crisis, I think it was that it worked so well. So, for example, Fannie, Freddie, Lehman, WAMU all had big events of default with huge numbers of offsetting, but clearly people were taking credit risk with each other, offsetting derivatives on those credits. They settled and they cleared. And in the benefit of hindsight, that means people were able to hedge their risk, lay off risks, protect themselves, and it worked very well, better than I would have thought. I don't think we should rely on, I think that was lucky, and I think the amount of attention and time that people, regulators, the industry, legislators are focused on making sure that the instrumentality and the pipes of clearing derivatives are in place is highly justified, notwithstanding we didn't specifically have a derivatives crisis.
Do you think that the failure or near failure of AIG was related to credit swaps, that is, credit default swaps? And do you think that having clearing would have in any way reduced the risks inherent in AIG's position?
I believe that it wouldn't, it may have helped a bit. I don't think that was a key thing. AIG was bent on taking a lot of credit risk. They took that credit risk in the derivatives market. They took that business by writing insurance against credit events. They took it by holding securities. It was a failure of risk management of colossal proportion, and there were derivatives in there, but it was really, those were merely mechanisms of taking credit exposure to get paid for that exposure that they took through multiple kinds of vehicles and could have substituted other vehicles for them.
Do you think, how would having a clearinghouse and having exchange trading of standardized derivatives reduce systemic risk, as you said in your testimony? I think that to the extent that you have starting with a clearinghouse, to the extent that you have a clearinghouse, the issue we had with an AIG vis-a-vis margin, or fighting over settlements or what a mark-to-market should be for the smooth transfer of margin, we would have avoided. We got margin for them, but it was hard to get out of them. It was slow. It lagged what we thought the mark-to-markets. In a clearinghouse context, that would be easier to do. So anything that's liquid enough and could be priced easily to go through a clearinghouse should. If further, it's standardized so it could trade liquidly on an exchange, then it should. I wouldn't banish bespoke and tailored solutions that couldn't trade on an exchange because they serve a useful purpose. If somebody wants to hedge their grade of oil, let them hedge their grade of oil. Don't force them to hedge a different kind of oil. But what could be on an exchange should be on an exchange. Those that can't could be through a clearinghouse, and those that still can't can be bespoke bilateral contracts between companies, but they should be surveilled and subject to extra capital. Thank you. Mr. Mack, I think in your testimony you indicated that you thought that clearing would be a valuable reform effort at this point. Would you comment on that?
Happy to, but as Mr. Blankfein said, it really would alleviate some of the issues of settling up with your counterparty. So not to be redundant, but it would be very helpful. You'd have better discovery. You would shrink, I think, some of the notional amounts by being able to do that. So I think it would go a long way in helping us, especially in times of crisis. But away from that, it makes sense to do. And if you go back not too many years ago when we were able to put swaps business into that clearinghouse, that's helped us on swaps.
Could you tell me how much, I understand that only standardized contracts could be exchange traded and cleared easily, and that bespoke, customized contracts, because they wouldn't be part of a fungible group, are not as amenable to clearing. Could you tell me what percentage of the over-the-counter derivatives that your business is involved in are standardized as opposed to bespoke or customized?
I can't give you an exact percentage. I will get you that information, but predominantly they are standardized. But we will give you the exact numbers, but I don't have that at the top of my head.
Mr. Blankfein, could you tell me what percentage of your business and over-the-counter derivatives dealing are standardized?
No, I can't. I would have to look at it, and I would guess that our business mixes would be different from each other. We have different places in the market.
I would appreciate it if each of the witnesses could provide the Commission with information on the percentage of standardized contracts that your over-the-counter derivatives dealing business has dealt in, say, for the last 4 years, please?
Commissioner, yield on my time on that point?
I would a little.
If in fact we created, no, it's my time. Yours is being saved. If we created the standardized versus bespoke versus what the ratio was over the last 4 years, don't you think it would change over the next 4 years in terms of a whole lot more bespoke and fewer standardized?
Yeah, I don't know. I mean, I don't think
it always works that way, doesn't it?
I don't know.
We'll see.
We've estimated about 70. First of all, a lot of derivatives are already on exchanges or clearinghouses. Right. So I'm talking about just credit derivatives. We estimate 70 or 80% will go in a clearinghouse. And I think one of the big fears of regulators or the public has been that if you leave this opening for over-the-counter, well, that's just a way that you can put a lot of stuff in there. The requirement should be that if it could be cleared, it should be cleared. And I think the regulators can limit and charge capital against the over-the-counter things that remain in a way that everyone's comfortable.
Thank you. Thank you.
Let me make it clear. I would like, just so you know what our motivations are, I would like more things to go through a clearinghouse. The biggest problems that we had during this period was counterparty risk. And so it would really suit us to have everything, not just that are standardized, that could be standardized and make sense to go on those clearinghouse arrangements. In fact, the industry has been driving this.
Ms. Bourne, back on your time.
Thank you. Have any of your institutions changed your operations in terms of over-the-counter derivatives dealing in light of what was learned through the financial crisis? Mr. Moynihan.
I think the point about the credit risk and understanding counterparty risk, I think everybody in our firm did a lot of work on 07, 08, and the regulators have looked at it very carefully because that was the risk that built up in a way that I don't think people anticipated. So that's where we spent a lot of our time, not only the core economics but also the underlying credit risk that comes with these transactions.
Mr. Diamond.
I'll go. I mean, other than being more vigilant, I think not a lot, but I will make one exception. We probably spend a little more time now looking at our exposure to another large financial company, so we are more prepared in case they have problems, since we have a lot of contracts with other companies.
Thank you.
Do you need another minute or so? Are you okay?
I would like another minute just to ask one follow-up question to questioning that Commissioner Wallison made. I would very much appreciate it if each of you could submit to the Commission information on your proprietary trading over the last 4 years. That is, the kinds of trading that you were engaged in, whether it was speculative, the degree to which it was hedging your risk, and the revenues and profits for each of the last 4 years. Thank you.
Okay, thank you, Commissioner Bourne. Mr. Vice Chairman.
Thank you, Mr. Chairman. First of all, I want to thank all of you. We have a very difficult job, and when you rely on secondary and tertiary sources, it makes it very, very difficult. And your willingness, one, to come in front of us and begin to answer the questions that we're asking. I might just tell you, Mr. Chairman, based upon my request, we've already, over the web, and I have some directed specifically to some of you. I won't ask them now, but we'll get it back in writing and we'll communicate. We've got California, Tennessee, Connecticut, Missouri, and more coming in. This is going to be very useful to us. We want to assure you, as we have the administration, that any information provided to us will be handled in the appropriate legal and protective ways, especially sensitive with the Private Sector on Trade Secrets Act and other information. It's just that without your help in follow-up questions that we will ask to get some detailed understanding, that we can provide not just the rough picture of what happened, but a more nuanced, understood, in-depth picture of what happened, because frankly, an argument that I made a lot and then quit making when I was in Congress is that it's basically you just don't understand what we're doing in the context we're doing it, and I'm sure you've heard a lot of that. Our job, hopefully, is to provide as mild and easy a form of education as possible, just how complicated this world is today and what makes it go round. Your help in that regard, as I said, is invaluable. We'll ask you questions. We would hope we get a timely response, and as we get nearer our time to exist, it will be a bit pushier in terms of getting your response. But once again, Mr. Chairman, I want to thank the panel, one, for their willingness to come, two, their openness in response, and three, the answers you'll be giving us over the course of the next 8 months. Thank you very much.
Thank you, Mr. Vice Chairman, members. There is, I know you'll be glad to know, a little remaining time, so I'd like to just ask a few follow-up questions before we move out of here. And Mr. Blankfein, maybe you're going to suffer from me having been A all my life and you having been B, but I do want to revisit some of the issues we talked about. And let me preface this by saying if I die 51% right and 49% wrong, I will be a happy man. But I do believe that one of the issues we must explore is, was this purely a perfect storm, or was it a man-made perfect storm in which the clouds receded? And that's why I'm driving towards questions and answers about responsibility. Now, I'm going to put aside for a minute my view that I'm troubled by your inability to accept the probability or certainty that your firm would not have made it through the storm for the vast array of federal assistance. But I really want to turn to this issue of mortgages, which you securitized, as did other firms. B of A stopped making subprime loans in 2001, but you still did securitize mortgage packages, Alt-A, jumbo, that had significant problems, 16 to 25% default. So maybe this is like the murder on the Orient Express. Everyone did it. Having said that, Mr. Blankfein, I read your testimony. You said there was cheap money, albeit there was. There was public policy driving this mortgage business, but you weren't subject to the Community Reinvestment Act. There were the standards of the time, but I would hope that we always would try to elevate standards. I think what I'm bothered by is this. You weren't just a market maker. You were securitizing and underwriting packages of mortgages. And when it was clear the market was going bad, even though there was information about bad lending practices that other people moved on, you kept moving this product in the market. And I guess what I'd ask you is, what is your responsibility when you put your name on a security to investor to underwrite that thoroughly? There were FBI warnings, there were loan tapes available. Did you fail in that respect, in that you did not underwrite the loans that you then securitized and moved into the market?
Mr. Chairman, all these loans, what we did in that business was underwrite to, again, the most sophisticated investors who sought that exposure. I know it's become part of the narrative to some extent that people knew what was going to happen at every minute. We did not know at any minute what would happen next, even though there was a lot of writing. The FBI may have wrote a report in 2004, but I will tell you that there were people in the market who thought that it was going down, and there were others who thought, gee, these prices have gone down so much, they're going to bounce up again. I remember being teased because at my shareholders meeting early in 2007, somebody asked me what inning were we in, and I said the 7th inning of the crisis. And of course, it turned out not to be the 7th inning, it turned out to be the 2nd inning. What was and so what we were doing was we were creating process. If you ask me, do I wish we had done it? No. Yes.
I think I'm asking a more direct question. Was your due diligence adequate?
Well, that could be.
I mean, did you scour loan tapes? Did you dig deep into looking at what you were moving, the actual product? And I guess the question is, isn't that, you know, in the 1920s, everything's different. But Wall Street banks were selling bad Latin American debt. I guess at what point do you have a responsibility? What is the sense of responsibility?
Well, we have a responsibility to be open and to tell people what they're having, but in our part of the market...
Not to ensure a good product unto itself?
Good product that creates the exposure that these professional investors are seeking. Right now, you could buy, we would underwrite distressed product as long as we disclose it, help somebody move that distressed product off their balance sheet and give it to somebody, a sophisticated investor, knowing what the product did, would give them that exposure.
But you were doing more than that. Let me just say, you were facilitating the market in which products were being offered in the consumer marketplace that were clearly deficient and unsustainable.
Yes, yes, for sure. Okay. It had that effect. By allowing that to turn over and by us giving the dollars back to the originators in exchange for the loans, it allowed them to go out and originate more loans. So to that extent, we played a part in making that market big, all of us as syndicators, you doing what the capital markets do, which is give people access to capital. And so that was a role that...
Well, apropos of Mr. Mack's rather compelling statements about regulation recently, we cannot control ourselves, you have to step in and control the street. Is this an argument for very tough regulation of products offered at the ground level? Because of the inability of the chain of securitization and the chain of private players to control the quality?
I think nobody, looking what happened, and the most horrible thing of this crisis, what has happened to consumers, to individuals, in the mortgage market, in other things who've taken on debt as a consequence also of behavior, and the confluence of behavior and the recession, I would say no one would argue that there shouldn't be more protection and safeguards and regulation of that interaction between finance and the consumer.
All right. There's 1 minute left, and the only final question I have is you, Mr. Diamond. How do you correct the asymmetry in compensation? Let me just say it simply. I was in the private sector half my life. I was in a business where you put real equity at risk, and if you lost, you lost. You bet big, you could also lose big. There's an asymmetry here where in the financial services industry it seems that it's almost like you're at a blackjack table in which you never really get wiped out. At the end of the day, the worst you can do is walk out with what you had. On the other hand, if you hit big, you can hit big. It seems to always tilt towards making the biggest bet possible because there's no consequence for the biggest bets. How do you correct that?
Well, I think there's a consequence. You can lose your job, you can lose your reputation. But I do think you raise an issue. The first way to correct it is that you actually risk adjust it, to actually look at the capital being deployed and you make an evaluation. Did they do the right things for the right reason, for the client, et cetera? So you are constantly trying to evaluate, are you doing the right things at the trading desk? And, but it is a little one-sided that way. And the more senior the people become, the more stock they own in the company. So they are responsible for the well-being of the whole company, and they will pay a price if our company pays a price. I think that's generally true. You know, and you've seen that a lot of the companies that went belly up, their people did pay a price.
Even though the Harvard study by Professor Bubchak said that even in those instances, people took out hundreds of millions of current compensation. So downside compared to what most Americans feel is not nearly the same.
Right, but they should redo some of those numbers in that study because they weren't all right.
We'll debate that after this session. Members of the Commission, members of the public, the gentleman who came before us today, thank you very, very much for coming here. Thank you for adding to our work and appreciate it. We will be posing written questions to each and every one of you. Thank you. Panel, ladies, photographers, hold on a minute.
No, nail them.
Folks, hey, clear out of there, guys. Hang on. We're still trying to do a meeting.
Please leave the well.
Yes. Move aside.
The hearing is not recent.
Yes. We appreciate your fervor to inform the public, but we will take a 25-minute break, and commencing at 12:45, we will be moving to the second session of this hearing. Thank you all very much.
Yeah, you're going to do that.
Fire the photographers in the well. You let the photographers in the well. You know what?
Oh, yeah.
Chairman. Have you seen it here? Excuse me. What happened? 200,000 people. So we have people get paid in branch centers and operating centers and investment bankers, and we have to look each person in the face and say we're treating you fairly as an individual and our shareholder.
Okay, but we're seeing huge bonuses at a time when there's a big unemployment rate. I mean, how do you explain it?
Compensation levels of top executives. That's what's outrageous.
I think that companies who badly, they shouldn't be paying their senior management a lot of money.
You and your colleagues blamed lack of regulation as part of the reason for the process, and you're endorsing the current regulation that's going on now. Does that mean that you're not going to spend millions of dollars on lobbyists to block regulation proposals that are going through Congress?
Two different things. First of all, I've been completely clear throughout that I don't blame the regulators at all, ever, not even once for what happened. The people who should be blamed are the people in the management of the companies that failed. That's who should be blamed. So having said that, the regulators should look at it and say, well, what could they have done better to avoid a problem like that? And lobbyists, I think people have the right to raise issues with their government. I mean, that is what democracy is about. Most lobbyists are very often were asked to give testimony like this, like what are the facts, what are the information. And J.P. Morgan Chase has always tried to help and do the right thing in every way possible, both providing information, doing analysis. And I don't think that's inappropriate at all.
Mr. Dunn, at the same time that you're here, the President is talking about imposing a new tax on banks to try and cover the costs of the bailout, to try and recoup some of that money. What do you make of that proposal when at the same time they're asking you to do more lending?
Right. So I haven't really seen the proposal, and I think it's kind of leaked out, so I'm not sure it's there. I think using tax policy to punish people is a bad idea. I think that, but if you step away from that, when we talk today about enhanced resolution authority, I think the industry should pay for the cost of that, unrelated to taxes. I also think it's very hard to have the industry pay for the auto companies. I mean, at one point you got to be a little fair.
But will those taxes be passed on to ordinary Americans?
I don't know what the tax is yet or how it's designed, et cetera. And, but all businesses tend to pass their costs on to their customers. That's not abnormal.
Jamie, are you going to be able to win this? Are you going to be able to win this fight over this debate over size? You made the argument here that size can be an important factor in determining whether or not banks survive here. You're going to win that fight because there are a lot of people here in Congress, who say, listen, banks like yours should be barred from doing investment banking. They should be smaller.
First of all, one of the things that came out today is the Glass-Steagall coming down caught the problems. Remember, most of these problems are monoline investment banks, finance companies, insurance companies, mortgage brokers, and thrifts. They were not because of the combination of the combination of commercial banking and investment banking. And size, look, I think the Commission will be looking at these facts. A lot of companies are big because they're required to be because the economies of scale. The size of the investments, the size of the data centers. J.P. Morgan does business in 100 different countries. We lend billions of dollars to California. We follow, Fortune 500 companies around the world and help them do what they do. You can't do that if you're small. There is a reason you have size, and if there wasn't a reason, well, sure, I'd say then you could have a debate why you need to be that big.
How worried are you about the public backlash over pay?
Just one last thing. Does Wall Street get it? I mean, you heard the President suggest that you guys don't get it. You don't understand the anger of taxpayers, people suffering the high unemployment rate.
That was my point.
Mr. Thomas?
Thank you very much, Mr. Chairman. I'd ask unanimous consent that my written statement be made a part of the record. And I just want to thank all of the commissioners. We've been doing a lot of that 7/8 of the iceberg underwater, and people are now going to see the 1/8 that you usually see above water. I think all of us are conscious of the fact that these hearings, notwithstanding the drama of the hearings, is not the fundamental work that is before us. It is, as you indicated, asking the questions the American people would like answered, and doing it in a way in which we increase the understanding, the comprehension of what happened, obviously for the purpose of not having it happen again. Thank you, Chairman.
Thank you, Mr. Vice Chairman. And now we will go to the witnesses on our first panel. Let me say that it will be the common and customary practice of this commission in public hearing to swear witnesses in terms of their testimony. So this is not unusual. And with that, though, I would like to ask each of the witnesses to be sworn. And I'd like to ask that you stand so that we may swear you in, as is, I said, the common practice. I should stand. Do you solemnly swear or affirm, under the penalty of perjury, that the testimony you are about to provide the Commission will be the truth, the whole truth, and nothing but the truth, to the best of your knowledge? Thank you so very much. Now, gentlemen, thank you very much for being here today. We appreciate you coming here. We appreciate you sharing your views with us. I should tell everyone here that each of the witnesses today has submitted written testimony, which will be available on our website, which is fcic.gov. It is also, I believe, available in the room today. We have asked each of the panelists to make opening statements of no more than 10 minutes. And so I think we'd like to proceed with that. I will signal you when there is 1 minute to go so that you can wrap up. And so let's do this then. I think with that, I'd like to start with Mr. Blankfein. We're going to go in alphabetical order. Mr. Blankfein, please proceed.
Thank you, Chairman Angelides, Vice Chairman Thomas, and members of the Commission. Thank you for the opportunity to contribute to the Commission's work to understand the causes of the financial crisis. Goldman Sachs was established 141 years ago. We are an institutional-focused firm providing investment banking, market making, and investment management services to corporations, institutions, governments, and high-net-worth individuals. As an underwriter, we help our clients access equity and debt capital markets in order to grow their businesses. As an advisor, we assess and facilitate strategic options for mergers and acquisitions. We provide the necessary liquidity as market makers to help ensure that buyers and sellers can complete their transactions and securities markets can function efficiently. And as an asset manager, we help public and private pension funds, corporations, not-for-profit organizations, and high-net-worth individuals plan, manage, and invest their financial assets for the long term. To begin on a more general point, any examination of the financial crisis should set out with an understanding of some of the global economic and financial dynamics of the last 2 decades. The growth in the amount of foreign capital, 10 years of low long-term interest rates, and other factors coalesced over many years to create a sustained period of cheap credit and excess liquidity. This, in turn, generated a desire to find new investment opportunities with higher returns. Many of the best were thought to be in residential housing. One contributing factor to the attractiveness of the housing market was public policy's active support of the expansion of home ownership, recognizing the societal benefits. For our industry, it is important to reflect on some of the lessons learned and mistakes made over the course of the crisis. At the top of my list are the rationalizations that we made to justify that the downward pricing of risk was different. While we recognize that credit standards were loosening, we rationalized the reasons with arguments such as the emerging markets were growing more rapidly, the risk mitigants were better, there was more than enough liquidity in the system. A systemic lack of skepticism was equally true with respect to credit ratings. Rather than undertake their own analysis, too many financial institutions relied on the rating agencies to do the central work of risk analysis. Another failure of risk management concerned the fact that risk models, particularly those predicated on historical data, were too often allowed to substitute for judgment. Next, size mattered. whether you own $5 billion or $50 billion of supposedly no-risk super senior debt in a CDO, the likelihood of loss rate would appear to be the same. But the consequences of a miscalculation were obviously much bigger if you had a $50 billion exposure. Third, risk monitoring failed to capture the risk inherent in off-balance sheet activities, such as structured investment vehicles or SIVs. It seems clear now that financial institutions with large off-balance sheet exposure didn't appreciate the full magnitude of the economic risks they were exposed to. Equally worrying, their counterparties were unaware of the full extent of those vehicles and therefore could not accurately assess the risk of doing business. Fourth, assets at certain institutions weren't valued at their fair market value, the price at which willing buyers and sellers transact. One consequence was that losses weren't seen early enough, so risks weren't curtailed. A second consequence was that bank balance sheets became suspect. As a result, lending between counterparties froze. Fifth, financial institutions simply didn't have enough capital to meet the extraordinary market environment that arose after a long period of benign conditions. Lastly, the role we play in the capital markets is to support economic growth. Some of the activities we undertook contributed to the prevailing mood of the time. We didn't know it then or even today when it actually crossed over into bubble territory. But we lent money out too cheaply and in certain loans without the traditional safeguards. We didn't recognize early enough that risk was being mispriced. We made too many liquid investments, particularly in real estate, and we were too concentrated in certain areas, namely leveraged loans. Given the competitive focus on maintaining market share, we didn't see as clearly as I would have hoped the excesses, so we didn't raise a hand and ask whether some of those trends and practices that became commonplace really serve the financial system's interests. Going forward, I hope that one of the improvements made will be the creation of a mechanism by which the industry and regulators can step back, try to assess if markets have gone too far, and consider what needs to be done. In light of these lessons, it is important to consider principles for our industry and for policymakers as we move towards reform. Risk and control functions need to be completely independent from the business units, and clarity as to whom risk and control managers report is crucial to maintaining that independence. To increase overall transparency and help ensure that book value really means book value, regulators should require that all assets across a large financial institution with a capital markets business be accounted for on a fair value basis. Also, all of the exposures of a financial institution should be reflected through its P&L. In this vein, valuation and capital standards across risky assets, regardless of the form or legal entity in which they are held, must be consistent. One of the larger stresses placed on Goldman Sachs and other firms during the height of the crisis was the possibility that we were managing risk in the same way other institutions, which were severely hampered or later failed, had managed their risks. Getting the market to recognize that our balance sheet was well marked and that our reported capital levels were accurate was one of our most significant challenges. Without question, direct government support was critical in stabilizing the financial system, and we benefited from it. The system clearly needs to be structured so that, in the future, private capital, rather than government capital, is used to stabilize troubled firms promptly before a crisis takes hold. The two mechanisms that seem to hold the most promise for addressing this goal and addressing too big to fail are ongoing stress tests, which are made public, and contingent capital, possibly
the first meeting of a commission appointed by Congress to examine the events of last year's near collapse of the financial services industry. Witnesses today include top executives from Goldman Sachs, J.P. Morgan Chase, Morgan Stanley, and Bank of America. The commission, made up of 6 Democrats and 4 Republicans, is required to deliver a report to Congress by December 15th of this year. Former California Treasurer Phil Angelides chairs the commission, and former House Ways and Means Committee Chairman Bill Thomas is co-chairman. This first panel is 3 hours 20 minutes.
The meeting of the, oh good, the mics work. The meeting of the Financial Crisis Inquiry Commission will come to order. There is a quorum present, and so we will now proceed with this first of our public hearings. Good morning to everyone, and thank you for being here. I'm honored to welcome you as we start this series of public hearings into the causes of the financial and economic crisis that's gripped this entire country. I thank Vice Chairman Thomas for his extraordinary cooperation and partnership. I applaud the dedication of my fellow commissioners, and I'm grateful to all of our witnesses for giving us their testimony and sharing their wisdom. We've been given a critical mission, one that goes far beyond any party or even policy agenda, to conduct a full and fair inquiry into what brought America's financial system to its knees. We're after the truth, the hard facts, because it's our job to provide an unbiased accounting of the actions that led to devastating economic consequences for so many American families. We'll follow the evidence wherever it leads. We'll use our subpoena power as needed. And if we find wrongdoing, we will refer it to the proper authorities. That's what the American people want. That's what they deserve, and that's what this commission is going to give them. Some already speak of the financial crisis in the past tense as some kind of historical event. The truth is, it is still here and still very real. 26 million Americans are unemployed or can't find full-time work or have given up even looking for jobs. Over 2 million families have lost their homes to foreclosure in the last 3 years. Millions more have a very legitimate fear that they will. Retirement accounts and life savings have been swept away, vanished, like some day trade gone bad. People are angry. They have a right to be. The fact is that Wall Street is enjoying record profits and bonuses in the wake of receiving trillions of dollars in government assistance, while so many families are struggling to stay afloat, has only heightened the sense of confusion. I see this commission as a proxy for the American people, their eyes, their ears, and possibly also their voice. This forum may be the only opportunity to have their questions asked and answered. This forum may be our last best chance to take stock of what really happened so that we can learn from it and restore faith in our economic system. If we ignore history, we're doomed to bail it out again. And so we expect our witnesses before us to be forthright. We need candor about the past so we can face the future. Today's hearing is the beginning, not the end of our questioning. We'll hold hearings throughout the year and take testimony from hundreds of individuals. Witnesses called to testify today are likely to come before us again as this investigation and inquiry unfolds. Those who haven't yet been asked to appear should be confident of this. We intend to thoroughly question individuals and institutions relevant to our inquiry. Let me close with this thought. My father grew up in the Great Depression. Like so many of his generation, he was shaped by sacrifice, hardened by economic hardship and war, keenly aware of the financial recklessness that made his life and the life of so many others so much harder than it needed to be. His generation learned the lessons of financial disaster so that the country could avoid it for decades. Let us learn the lessons of our time. Let us be diligent and thoughtful today so that our financial and economic system can fully rebound and enrich and sustain Americans for the years to come.
Triggered by failing a stress test. These two elements could also be the core of a strong but flexible resolution authority. Certainly, enhanced capital requirements in general will reduce systemic risk, but we should not overlook liquidity. If a significant portion of an institution's assets are impaired and illiquid, and its funding is reliant on short-term borrowing, low leverage will not be much comfort. Regulators should lay out standards that emphasize prudence and the need for longer-term maturities depending on the assets being funded. Institutions should also be required to carry a significant amount of cash at all times, ensuring against extreme events. Lastly, I want to briefly discuss our firm's experience during 2008 and 2009. While we certainly had to deal with our share of challenges during the financial crisis, Goldman Sachs was profitable in 2008. As I look back to the beginning and throughout the course of the crisis, we couldn't anticipate its extent. We didn't know at any moment if asset prices would deteriorate further or had declined too much and would snap back. Having to fair value our assets on a daily basis and see the results of that marking in our P&L forced us to cut risk regardless of market or individual views, estimates, or expectations. Throughout 2007, we were committed to reducing certain of our risk exposures, even though we sold at prices many in the market, including at times ourselves, thought were irrational or temporary. After the fact, it is easy to be convinced that the signs were visible and compelling. In hindsight, events not only look predictable, but sometimes look like they were obvious or known. The truth is that no one knows what is going to happen, and that recognition defined our approach to risk management. We believe key attributes of our strategy, culture, and processes were validated during the extraordinary events and macroeconomic uncertainty of the past year, but they have also prompted change within our firm. Over the last 18 months, our balance sheet has been reduced by a quarter, while our capital has increased by over a half. Our Basel I Tier 1 capital ratio has increased to 14.5% through earnings generation and a number of capital offerings. Our pool of liquidity was relatively high at the onset of the crisis, but we carry a great deal more cash on our balance sheet than ever before to deal with contingencies. While we believe our firm has produced a strong relationship between compensation and performance, we have announced additional reforms in this area. At our shareholders' meeting last year, we outlined specific compensation principles. Consistent with those principles, in December, we announced that the firm's entire management committee will receive 100% of their discretionary compensation in the form of shares at risk, which cannot be sold for 5 years. In addition, we announced that the 5-year holding period on shares at risk includes an enhanced recapture provision that will permit the firm to recapture the shares in cases where the employee engaged in materially improper risk analysis or failed sufficiently to raise concerns about risk. Finally, our shareholders will have an advisory vote on the firm's compensation principles and the compensations of its named executive officers at the firm's annual meeting of shareholders in 2010. Once again, we appreciate the opportunity to assist the Commission in your critical role, and I look forward to your questions. Thank you.
Thank you very much. Thank you so much. Mr. Diamond.
Chairman Angelides, Vice Chairman Thomas.
If you touch the button on your mic, and if you move the mic fairly close to you, because they're very distance sensitive.
Sir.
Thank you.
Chairman Angelides, Vice Chairman Thomas, and members of the Commission, my name is Jamie Dimon, and I'm Chairman and Chief Executive Officer of J.P. Chase & Company. I appreciate the invitation to appear before you today. If we are to learn from this crisis moving forward, we must be brutally honest about the causes and develop a realistic understanding of them that is not overly simplistic. The FCIC's contribution to this debate is critical, and I hope my participation will further the Commission's goals. I would like to start by touching on some of the factors I believe led to the financial crisis. Of course, much has been said and much more will be written on the topic, so my comments are summary in nature. As we know all too well, new and poorly underwritten mortgage products help fuel housing price appreciation, excessive speculation, and far higher credit losses. When the housing bubble burst, it exposed serious flaws in mortgage underwriting, and losses flowed from the chain from mortgages to securitizations to derivatives based on these products. Excessive leverage by many U.S. investment banks, foreign banks, commercial banks, and even consumers pervaded the system. This included hedge funds, private equity firms, banks, and non-banks using off-balance sheet vehicles. There were also several structural risks and imbalances that grew in the lead-up to the crisis. There was an over-reliance on short-term financing to support liquid long-term assets, and over time, certain financing terms became too lax. Another factor in the crisis was clearly our regulatory system. I want to be clear, I do not blame the regulators. While they obviously have a critical role to play, the responsibility for a company's actions rests solely on the company's management. But we should also look to see what could have been done better in the regulatory system. We have known that our system is poorly organized with overlapping responsibilities. Statutory authority they needed to address the failure of large global financial companies. Much of the mortgage business was not regulated or lacked uniform treatment. Basel II capital standards allowed too much leverage at investment banks and other firms and did not incorporate liquidity at all. The extraordinary growth and high leverage of the GSEs also added to the risk. We also learned that our system has many embedded pro-cyclical biases, a number of which proved harmful in times of economic stress. Loan loss reserving methodologies cause reserves to be at their lowest levels at a time when high provisioning might be needed the most. Certain regulatory capital standards are also pro-cyclical, and continuous downgrades by credit agencies also required many financial institutions to raise more capital. When all is said and done, I believe it will be found that macroeconomic factors will have been some of the fundamental underlying cause of the crisis. Huge trade and financing imbalances caused large distortions in interest rates and consumption. As for J.P. Morgan Chase, the last year and a half was one of the most challenging periods in our company's history. I'm immensely proud of the way our employees continue to serve our customers through this difficult time. Throughout the financial crisis, we never posted a quarterly loss. We served as a safe haven for depositors. We worked closely with the federal government, and we remained an active lender. I would like to describe some of the regular business practices that we believe protected us leading up to and during the crisis. If we weren't doing these things right going into the crisis, it would have been too late to start once the crisis began. J.P. Morgan Chase did not unduly leverage our capital or rely on low-quality capital. We've always used conservative accounting and vigilant risk management, built up strong loan loss reserves, and maintained a high level of liquidity. We always believed in maintaining a fortress balance sheet. We continually stress test our capital and liquidity to ensure that we can withstand a wide range of highly unlikely but still possible negative scenarios. We did not build up our structured finance business. While we were large participants in the asset-backed securities market, we deliberately avoided large risky positions on structured CDOs. We avoided short-term funding of liquid assets and did not rely heavily on wholesale funding. In addition, we essentially stayed away from sponsoring SIVs and minimized our financing of them. Even before 2005, we recognized that credit losses were extremely low, and we decided not to offer higher-risk, less-tested loan products. In particular, we did not write payment option ARMs. As I've said before, we did make mistakes, and there are a number of things we could have done better. First, we should have been more diligent when negotiating and structuring commitment letters for leveraged syndicated loan transactions. In response, we have tightened our lending standards as well as our oversight of loan commitments we make. Second, the underwriting standards in our mortgage business should have been higher. We have substantially enhanced our mortgage underwriting standards, essentially returning to traditional 80% loan-to-value ratios and requiring borrowers to document their income. We've also closed down almost all of the business originated by mortgage brokers, where credit losses have generally been over 2 times worse than the business we originate ourselves. Even so, we remained relatively strong throughout the crisis, so much so that when called upon to take action to help stabilize, we were called upon to take action to help stabilize the system. Over the weekend of March 15, 2008, the federal government asked us to assist in preventing Bear Stearns from going bankrupt before the opening of the Asian markets on Monday morning. And on September 25th, we acquired the deposits, assets, and certain liabilities of Washington Mutual from the FDIC. Later, we learned we were the only bank that was prepared to act immediately following the largest bank failure in U.S. history. In addition, we continue to lend and support our clients' financing and liquidity needs throughout the crisis. Over the course of the last year, we provided more than $800 billion in direct lending and capital raising for our investor and corporate clients. For example, we helped provide state and local government financing to cover cash flow shortfalls. We are the only institution that agreed to lend California $1.5 billion in its time of need. And even though small business loan demand has been down, we have maintained our lending levels to small business. In November of last year, we announced plans to increase lending to small businesses by $4 billion to a total of $10 billion this year. For the